So, how's the juice, guys? Come on, tell me now. How's the juice, everyone? Come on, come on, come on. Tell me the chat box. How's the juice, everyone? Exactly. High. It should be high, extreme high. Right now, is the audio and video clear to everyone? Come on, guys. Please tell me. Is the audio and video clear to everyone? Shall we start? Shall we start? Come on, guys. Come on, come on, come on. Wonderful. So yesterday we covered all the FR aspect of the SBR part. We covered already yesterday, right? We covered property, plant, equipment. We covered. You can say I'll show it to you. I'll show it to you. What all things we covered yesterday, and what all things are we are going to cover today. So we covered property, plant, equipment. We covered borrowing cost. We covered investment property, intangible assets, impairment, IFRS 5, 6, IFRS 16 leases, financial instruments, revenue, government grant, provision, events, income taxes, agriculture, inventories, earning per share, foreign currency transactions, IFRS 18. Now IAS 8, IFRS 18 I'll be covering today. IFRS 18 I'll be covering today. IFRS 13, and this is what we covered yesterday in the session. Now today we will be covering from an SBR perspective. Okay. Now, so the first topic that I have to cover up, the first topic which I have to cover up is point number one. Point number one is impairment. Of assets. So now what I have done for the today's session, based on the feedback that I have received for the yesterday's session, what I have done today, I'll just show you to you quickly, guys. Just give me a minute. Okay, now, so what I have done is I have already written here what exactly I have to cover, okay, standard by standard, and I'll be writing the notes here itself, okay. So now in the chapter of impairment, I will be covering the two-step approach, okay. So whatever are the incremental SBR topics, that is what I am going to cover today. Additionally, I have also brought examples for you guys. Can you see the example? See, for the two-step approach, examples, right? See, understand, guys. SBR is more about application. Do you agree with me on this part? SBR is more about application. Do you agree with me on this part? Okay, so now what I have done is, my intent here is to help you understand how to apply the concept in a given case scenario. This is what we are going to discuss in the today's session. Okay, now even though we have discussed taxes yesterday, even though we have discussed income taxes yesterday, but still, if you see here the notes, I will be covering the income taxes from an application perspective today as well. See here, income tax, the application, I will be discussing it today as well, right? So we will be discussing from an SBR perspective. Okay, now if you are an FR student, you are not required to continue with the session. You can leave the session. This session is specifically for the SBR students. Okay, it is not for FR students. Okay, now, so first of all, let's come to IAS 36, impairment of assets. Come on, guys, tell me, come on, quickly. Though we have already studied impairment yesterday, but let me help you quickly revise impairment. Whatever we studied yesterday, we'll quickly revise. Okay, now tell me, when do we impair the asset? Whenever there is an impairment, indicator, we test the asset for impairment. Testing the asset for impairment means what? Testing recoverable amount. What is the meaning of recoverable amount? Recoverable amount is higher of fair value less cost to sell, or you can say value in use. Now I believe you know the meaning of fair value less cost to sell and value in use, right? Fair value less cost to sell is fair value less the incremental cost to sell the asset. What is value in use? It is the present value of the cash flows generated from using the asset and the residual value. Okay, now, what is the treatment of impairment loss? The impairment loss comes up when recoverable amount is less than carrying amount of the asset. And whenever there is an impairment loss, ideally it is recognized in P and L. Ideally it is recognized in P and L. But if the asset is under revaluation model, first of all, we will recognize the impairment loss in OCI. To the extent there is a balance in revaluation reserve, any excess will go to P and L. Any excess will go to P and L. So for the students who are asking me again and again notes, let me tell you guys, notes I will be sharing tomorrow, okay? Because today I was fully caught up in preparing for my SBR marathon sessions, okay? So tomorrow by midday I will share the notes for FR and SBR both in my Telegram channel. Need not worry at all, okay? If I have promised, I will be giving it to you. Need not worry at all. Now, then, when we impair a cash generating unit, tell me what happens. We first of all allocate the impairment loss. In case of cash generating unit, we first of all allocate the impairment loss to specifically impaired asset. Guys, for those who are watching the recorded sessions, I will strongly recommend not to switch to 1.5x or 2x. Why? Because I am already speaking at 2x speed, so you are not required to further convert it into 2x, because in that case you will not understand each and anything, okay? So watch it at single pace, okay? Specifically impaired asset, then goodwill, then remaining impairment loss to remaining applicable asset in the ratio of their carrying amount, Now, so this is what we already studied yesterday. But now what is two-step approach? So basically what happens, let's suppose, please understand, if entity has multiple CGUs, if an entity has multiple CGUs and has a goodwill or a corporate asset which cannot be allocated to these CGUs, then basically that is unallocable goodwill or unallocable corporate asset. Then we apply two-step approach. What do we do in two-step approach? In step number one, what we do? We test individual CGUs for impairment. Excluding unallocable goodwill or unallocable corporate asset. Now in step 2, we test the entire entity for impairment. Okay, now including unallocable goodwill and unallocable corporate asset. Now what will be the outcome of this one? So in step number 1, whenever there is an impairment loss comes up, it is allocated to individual CGUs only, okay? But here, just a minute, here impairment loss will be allocated to unallocable goodwill or unallocable corporate asset, Okay, unallocable goodwill or unallocable corporate asset. For the students who are asking what is unallocable goodwill or unallocable corporate asset, point number one, guys, I assume that you guys have the basic understanding of the subject. Okay, now again, still I'm telling you, let me explain that unallocable goodwill means, okay, the company, let's suppose ITC, let's suppose Google Limited. Google Limited has one goodwill. Now, Google Limited might have multiple cash generating units. Now, this goodwill cannot be allocated to this individual CGUs, cannot be allocated to this individual CGUs. Okay, that's why we call it as unallocable goodwill or unallocable corporate asset. Corporate asset means, let's suppose head office building. Head office building is a corporate asset because this head office building is serving all the CGUs. Okay, so hence it can become unallocable. Is it clear, everyone? Is it clear, everyone? But still, now I have explained the concept, but just the concept explaining, will it help you? No. Shall I take up an example? Come on, guys, tell me. Shall I take up an example to explain this part? Okay, shall I take up an example to explain this part? Chalo, let us take up an example. Is the Excel file properly and clearly visible to all of you? Is the Excel file properly and clearly visible to all of you? Guys, one request. Please don't ask me to revisit the entire FR topics today. It will not be possible for me, because if we do that, it will be difficult for us to complete the session today. Okay, I will not be able to revisit the entire FR topics today. Okay, so if you want to, the recording is already available on my YouTube channel. You can just visit. See here, I'll show it to you. Just a minute, I'll show it to you. See, this is my YouTube channel by the name ACCA with Vishal Jain, where you are watching this session. You have to come to the live section. You have to come to the live section because it was conducted live yesterday, right? Here. See here, day one, right? So this is what it is. Okay. In this, I've covered all the FR topics. All the FR topics I've covered here. Okay. Chalo, let us come to this one. Such a group is made up of two cash generating units. The entity is made up of two cash generating units. Okay. Now, as a result of the combination of various past 100% acquisitions plus a head office is a corporate asset. Head office is a corporate asset which was not allocated to any cash generating unit. Means it's an unallocable. It is an unallocable corporate asset. It's an unallocable corporate asset. Okay. Now, if you see the question, there is a division A, there is division B, there is an head office which is unallocable, and there is an unallocable goodwill. So we have to apply two-step approach. Always see the question. If there is a word of unallocable or cannot be allocated, it means you have to apply two-step approach of impairment in that case. Okay. Now, the recoverable amount of the division A is given. Recoverable amount of division B is given. Only half question is visible. Just a minute, let me check. No, guys, I think full question is visible. I believe full question is visible. Now clear? Fine now? Chalo, theek hai. Good. Now, so division A, division B, head office, unallocable goodwill, the recoverable amount is given for both division A and division B. Okay. Now, you have to do the impairment testing. So what will you do in step one? In step one, what will you do? Tell me, guys, come on. What will you do in step one? Let me write here, step one. We will test the individual CGUs for impairment. Okay. So division A, division B. Tell me, what is the carrying amount of division A? 1020. What is the carrying amount of division B? 760. What is the recoverable amount of division A? What is the recoverable amount of division A? It is 1000. What is the recoverable amount of division B? It is 720. Okay, so what is the impairment loss? So what is the impairment loss? So impairment loss is this minus this is 20, and here the impairment loss is 40. Now tell me, where will you allocate this impairment loss? Where will you allocate this impairment? Okay. Now clear? Now clear? So where will you allocate this impairment loss? First of all, tell me. To goodwill. What is the goodwill of division A? 20, 60. So you will first allocate it to goodwill. You will allocate the entire to goodwill. Now this 40 is the impairment loss of division B. In division B, you have a goodwill of 30. So in goodwill, you will allocate 30, and remaining 10, can you allocate to net current assets? No, you can allocate to PPE. So you can allocate to PPE how much? 10. Tell me, is the individual impairment clear, everyone? Is the individual impairment clear, everyone? Okay, now tell me, what is the revised carrying amount of division A? 1000. Revised carrying amount of division B? 720. 720. Why? Because the carrying amount was 1020, you impaired by 20, so it became 1000. Carrying amount was 760, impaired by 40, it became 720. Now let us do the step 2. Step 2. In step 2, tell me, what is the carrying amount of division A? 1000. What is the carrying amount of division B? 720. Now tell me, these are already impaired. Tell me, will we impair it further? Are we going to impair it any further? Are we going to impair division A and division B any further? No, because they are already impaired. Now tell me, what is the head office? 110. Okay, what is the goodwill? 10. So these are unallocable. These are unallocable. These are unallocable. Similarly, this one also. Okay, so what is the total carrying amount? It is 1840. 1840. What is the recoverable amount of the group as a whole? It is how much? Tell me. What is the recoverable amount of the group as a whole? It is 1825. It is 1825. 1825. So what is the impairment loss? What is the impairment loss? 1840 minus 1825 is 15. 15 is the amount of impairment loss. Where will we allocate this impairment loss of 15? Where will we allocate? So now the question goes on to state that this head office has a fair value less cost of disposal of 85, means it is specifically impaired. So first of all, we will allocate it to HO 5, and then we will allocate it to, goodwill how much? 10. Then we'll allocate it to goodwill how much? 10. Okay, one student is saying goodwill 15. Why goodwill 15? Total impairment loss is 15. You have an unallocable goodwill of 10 only. How can you impair it by 15? You have unallocable goodwill of 10 only. How can you impair it by 15? You can't. Right? Now, but this is what is the question saying. But I have an additional query in this question. Whenever I discuss this question, I get one additional query which I want to discuss. Sir, tell me one scenario. What if, let's suppose, an impairment loss comes? See, this is, let's suppose an impairment loss comes up of 140. Let's suppose impairment loss comes up 140, then this is totally eroded. This is totally eroded by 120. The remaining 20 impairment loss, will we impair these two? Will we impair these two? Will we impair these two? Okay. So now please understand, guys. For the impairment loss to be 140, for the impairment loss to be 140, what should be the recoverable amount? 1700. Right? Then only the impairment loss can come to 140. But please understand, the impairment loss cannot be 114. There cannot be scenario itself. There cannot arise that scenario. Why? Because if I just take the recoverable amount of division A and division B, it is 1720. Means the lowest possible recoverable amount. The lowest possible recoverable amount is 1720. Recoverable amount cannot be below 1720 in any scenario. And if it is 1720, what is the impairment loss? 1840 minus 1720 is 120. Means maximum impairment loss that can come up is up to 120. Means in step number 2, these two divisions who are already tested for impairment here will not get further impaired. Is that clear to all of you? Come on, guys, tell me. Is that clear to all of you? Come on, guys, tell me, please. Is that clear to all of you? Come on, guys, tell me, please. Wonderful. Now moving on to the next topic. So with this, our impairment IAS 36 is over. Now can I move on to the next standard, that is leases? Tell me, guys, come on. Can I move on to the next standard of leases? Okay. Now in the leases, the first topic which I have to discuss with you is lease remeasurement. Tell me, guys, do you know what is lease remeasurement? Okay, so now in the case of lease remeasurement, basically standard says that whenever the estimates, so understand, when we calculate a lease liability, we make some estimates. In computing lease liability. Okay, so whenever there is a change of estimates, we remeasure lease liability. And this is called as a step of lease remeasurement. Okay, now just a minute. Okay, whenever the estimate changes, we remeasure lease liability. Sir, can you please give an example of lease remeasurement? Which scenario? Yes, buddy. So lease remeasurement examples can be one. Examples can be, you can say change of you can say index, change of guaranteed residual value, change of reasonable certainty to exercise options. Which options? Just a minute. Options. It can be extension option, renewal option, purchase option, termination option, any option. Okay. Now, so these are called as change of estimates. Now the standard says that whenever you are remeasuring your lease liability, please understand, standard says that change of index and change of guaranteed residual value is a small change, minor change. So here if you remeasure your lease liability here, remeasure using old discount rate. Old discount rate means the earlier discount rate which you used on the lease commencement date. Okay, now, but please understand, in case of change of the reasonable certainty of exercising the options, okay, now something significant is changing. Hence standard says that use or remeasure lease remeasure using new discount rate. New discount rate means the discount rate on the date of change of estimates. Now what is the process? What is the process of remeasurement accounting? What is the process of remeasurement accounting? Can you please tell me? Can anyone please tell me what is the process of remeasurement accounting? Okay, so point number one. Point number one is calculate carrying amount of lease liability and ROU. Point number two, remeasure lease liability. Okay, now using which rate? Using applicable discount rate. Using applicable discount rate. Using applicable discount rate. Using applicable discount rate. And I believe you know very well what is the applicable discount rate, right? If these are the change, you will use old discount rate. If these are the rates, you will use new discount rate. Okay, then calculate what is the change in lease liability, what is the change in lease liability, and make a corresponding change to ROU asset. Okay, now let's suppose journal entry to record this one. So journal entry will be lease liability. Okay, let's suppose your lease liability increases, so you will say ROU debit to lease liability. Done. Simple. If your lease liability increases by X amount, increase your ROU also by X amount. This is what is the treatment of lease remeasurement. Is that clear, everyone? Can we take up an example to understand this one? Come on, guys, tell me. If you will say no sir, I don't want example, I will not take up. You tell me, do you want to take up example? If you will tell me, sir, please take up example, then I will take up. But you have to tell me please for that. You have to request me for that. Sir, please take up examples. Okay, okay. Since you guys are insisting me so much, let us take up examples. Okay? Now, lease remeasurement. Now, is the question clearly visible to all of you? Shall I increase the size of this one? I think I should increase the size so that you can read it properly. Can you read the question properly, buddy? And tell me, guys, how bad it is. You guys are attending the session and not liking the session. Very bad. Come on, guys, everyone like it now, first of all. Then only I will start discussing it. Everyone, all of you, come on, please like the session first of all. Everyone like the session. Okay. Yesterday we studied for 8.5 hours at a stretch, right? And I trust me, guys, I really enjoyed that. And I want to give the same level of energy with same level of output today as well. Tell me, was the yesterday's session fruitful? It was fruitful, right? So let us, on the same note, let us today also discuss the examples, questions, the chapters, and help you revise the entire SBR as well, like we did for FR. Now understand. On 1st January 2003, LMN enters into a 5-year lease. Okay, 1st January 2003, 5-year lease of shop premises. The contract gives LMN an option to extend the lease for further 5 years. There is an extension option in the contract. The lease rental for the first 5 years is 40,000 per year, payable in advance. Make a note of it, guys. Payable in advance. And if element takes up the option, the lease rentals will increase to 50,000 per year. Okay, so meaning thereby for the original contract of 5 years, the lease rental is 40,000 per annum. For the renewal period, that is next 5 years, the lease rental will be 50,000 per annum. Okay, let me highlight it. Just a minute. Okay, now, due to uncertainty about level of revenue to be generated from the shop, LMN initially determines that the extension option will not be taken up. Okay, fine. So now come on guys, tell me. What on 1st January 2003, how will you record your lease liability and ROU? Come on, can you please help me with this? Can you please help me with the amount of lease liability and ROU on 1st January 2003? On the lease commencement date, this one. Come on, tell me. So what is the discount rate? Discount rate is 5%. Using 5% discount rate, can you please tell me what is the amount of lease liability? Let me calculate for 5 years, right? So 1.05 divided 1, 2, 3, 4, because it's advance, right? GT multiplied by 40,000 is 141,838. 141,840, right? And advance payment is 40,000. So what is your ROU? So your ROU is this plus this. Your ROU is this plus this. Is that clear, everyone? The accounting treatment on lease commencement date is clear to everyone? Come on guys, please tell me. The accounting treatment on lease commencement date, is it clear to everyone? Okay, now further, what does the question say? Okay, now based on the above information, the value of liability and the asset on 1st January 2006 immediately after the 4th installment would be this one. How is it calculated? Let us calculate it, guys. Okay, now this understand. ROU will be after depreciation. And lease liability will be after amortization. Okay, so the value is given for the lease liability is 38098 and ROU is 72736. It is given in the question itself. Okay, now further the question says on 1st January 2006, the directors of LMN decided that they would take the offer of 5-year extension. Now, initially they were not reasonably certain, but now they are reasonably certain. So we have to remeasure the lease liability because the estimates changes now. And now tell me, when we remeasure the lease liability, we will use the original discount rate of 5% or we will use the new discount rate of 6%. Come on guys, please tell me. Come on guys, tell me. Since it is a change of the option, so we'll use new discount rate. Now tell me, we have to compute the revised lease liability, remeasured lease liability. Now, what are the lease payments pending? Can you please tell me what are the lease payments pending? So lease payments, understand, for the initial term of 5 years, we have already paid 4 installments. See here, immediately after 4th installment, so we have already paid the 4th installment of the initial term. So one installment is pending, right? So one installment is how much? 40,000, and this we have to discount using 6%. So what is the discount factor of 6% for 1 year? It is 0.943. Okay, now further, we have 5 payments of 50,000. Discounted at the rate of 6%. So it is 50,000 multiply by, now we have to take the annuity factor, and the annuity factor for 6% 5 years. But the question gives you annuity factor of 6% 6 years. See here, 6% 6 years. But we need 6% 5 year. So how to compute that? Simple. It is equals to 50,000 multiplied by 4.917 is 6 year, minus for the 1 year is 0.943. 0.943, so it becomes 5 years, right? So it is how much? 198,700. 198,700. So what is the revised lease liability? 236,420. So carrying amount of lease liability, this is your revised lease liability. So what is the change in lease liability? This minus original 38098. So what is the revised lease liability? It is 198,322. 198,322. So what is the accounting treatment of it? What is the accounting treatment of it? So accounting, since the lease liability is increasing from this much to this much, let me highlight that, right? So lease liability is increasing from here till here. So lease liability is increasing by, sorry, no, not this one, sorry. Lease liability is increasing from here till here by this amount. So since the lease liability is increasing, so I can write here increase in lease liability, increase in lease liability. So since your lease liability is increasing, we will increase the ROU also. So it will be this is equals to this. Is it clear, everyone? Not 2 years. It is, you can say payment is for 1 year, but 2 years are pending. That's why I say 2 years, okay? Because it's in advance, okay? So lease payment for a 1 year, you can say. If you want to say from lease payment, 1 year of initial and lease payment of 5 years for extension option. Now, okay? Lease term was pending for 2 years. That's why I mentioned 2 years, but okay, doesn't matter, okay? Doesn't matter. I believe it is very much clear to all of you. Now, moving on to the different point. Lease modification. Lease modification. So please understand, in the case of lease modification, okay? So now lease modification means what? It means change of terms and conditions of the contract. Change of terms and conditions of the contract, okay? Of the lease contract, It can be increase in scope, it can be decrease in scope, it can be increase or decrease, just a minute, increase or decrease of scope, it can be increase or decrease of lease term, okay? It can be increase or decrease in lease payments, okay? But this much depth is not required in SBR syllabus. We just have a question of decrease of scope. We just have one simple question of decrease of scope, which is there in your ACCA study hub, which we can take up, the accounting treatment for decrease of scope, okay? Now, so what is the accounting treatment of decrease of scope? The accounting treatment of decrease of scope. Now, so point number one, first of all, calculate carrying amount of lease liability and ROU on date of decrease, then reduce lease liability and ROU proportionately. What is the meaning of proportionately? So if the scope has decreased by 50%, you will decrease a lease liability and ROU by 50%, okay? Now, any impact will be recognized in P and L, okay? Then remeasure remaining lease liability, okay? Whatever is the remaining lease payments, remeasure that, okay? Liability using revised or new discount rate and take the corresponding impact Tell me where will we take the corresponding impact? Where are we going to take the corresponding impact? To ROU asset. This is the accounting treatment of decrease of scope. Okay, so let us take up example of this one, a question of this one, so that we solve the question and we try to understand how exactly we can discuss this one, lease modification. Okay, chalo. Is it clearly visible, guys? Is it clearly visible, the question? Chalo, let us solve this question. Modification. Okay, on 1st January 20x3, FGH entered into a lease to lease 2 floors. 2 floor is the scope. 2 floor is the scope. Okay, now the lease period is 10 years. Annual rent is 1 lakh payable in arrears. Incremental borrowing rate is 6%. Okay, now on initial recognition, the ROU and lease liability is measured at 736,000. So we can say on 1st January 2003, that is a lease commencement date, we will measure the lease liability at 736,000 and ROU also at 736,000. Is that clear, everyone? Is that clear, everyone? Come on, guys, tell me, please. Okay. Now, on 1st January 20x7, on 1st January 2007, the lease liability is 491722 and the carrying amount of the asset is 441600. See, the question is very considerate here. They have given all the calculations. Very good, very good. But tell me, guys, even if the question is not giving the carrying amount, will you be able to find out the carrying amounts of lease liability and ROU? Will you be able to find out the carrying amount of lease liability and ROU? Will you be able to find out the carrying amount of lease liability and ROU? Right? So now it is 491722. ROU is 441600. Is that clear, everyone? Is that clear, everyone? Chalo. Now, what's next? What's next? On this date, FGH arranged with the lessor to continue the lease for just 1 floor. Please make a note here, my dear bacha party. Here we lease 2 floors. Oh, sorry, this color is not visible. Here we leased 2 floors. Now here we just want to continue for the lease of just 1 floor, reducing the scope by 50%. Reducing the scope by 50%. So now tell me, by what amount shall I decrease my lease liability and ROU? By what amount shall I decrease my lease liability and ROU? By what amount shall I decrease my lease liability and ROU? Come on, guys, tell me. 50%, right? So decrease in lease liability will be 50% into 0.5 and ROU also by 50%. So this is the decrease of lease liability and decrease of ROU asset. Now tell me, what should be the journal entry? What should be the journal entry? The journal entry will be lease liability reduced. So lease liability debit by what amount? This much. To ROU reduced. So to ROU credit by what amount? This much. Tell me, where will the impact go? Where will this impact be recognized? Where will this impact be recognized? Come on, guys, tell me, where will this impact be recognized? Just see what I have told here. Just see the notes. Just see the notes. The impact will be recognized in P and L. Right? So I'll write here to P and L credit. Done? Is it clear, everyone? Clear, everyone? Chalo, wonderful. Now further. Now it says that the lease rental for the remaining 6 years will be 55,000 each year. Incremental borrowing rate is 7%. So now tell me, what is the lease liability here? What is the lease liability here? It will be 55,000 multiplied by 4.767. 4.767. Right? This is your lease liability. This is your lease liability. Now, what is the change? What is the change? So your carrying amount, your reduced lease liability is how much? You had original lease liability this much, you reduced your lease liability by this much, so this was the reduced lease liability. This is the, sorry, this is the revised lease liability. So your change is how much? Your change in lease liability is 16324. So what will be the treatment for this one? What will be the treatment for this one? So the treatment will be increase, right? So ROU debit to lease liability credit by 16324. By 16324. Is it clear, everyone? Come on, guys, tell me. Is it clear, everyone? Is it clear, everyone? Done? Chalo. Now moving to sale and leaseback. So sale and leaseback I have already discussed yesterday, but now I have to take up one different scenario. Okay, in the yesterday's scenario I discussed a sale and leaseback accounting whereby the sale price was at fair value. Sale price was at fair value. But today we have to discuss what if the sale price, what if the sale price, what if sale and leaseback, okay, what if sale price is greater than fair value? Then what will happen? This is what we are going to discuss today. Okay, now so the treatment is very simple. The treatment is in excess of sale price over fair value is recognized as, tell me what, as recognized as what? Financial liability. Is recognized as financial liability. Is it clear, everyone? Come on, guys, please tell me. Clear, everyone? Chalo, let us discuss this question. On 1st January 2008, Juno company enters into a sale and leaseback contract to sell for 1 million, to sell for 1 million. Okay, the carrying amount of the asset is 600,000 and the fair value is 900,000. Okay. So tell me, what is the treatment of this sale? What is the treatment of the sale? So in the bank, how much have I received? Tell me, in the bank, how much did I receive? In the bank, we have received 1 million. In the bank, we have received 1 million. Okay. Now, we have to derecognize the asset. What is the carrying amount of the asset? 600,000. Okay, so what is our gain? What is our gain? So now you will say, sir, my gain is 400,000. But no, bacha party, please understand here that, see, the fair value is 900. You have sold for 1 million. Is it possible? Is it in the market terms? No. See, basically the standard is saying if you have sold over and above the fair value, means the excess amount has to be returned back to the financing company by way of increased lease payments. So that's your financial liability. So I will say 2FL, how much? Credit, how much? 100,000. What is the gain? What is your gain? So your gain is 300,000. Tell me, is it clear, everyone? Is it clear, everyone? Rest all the treatment is same. Rest all the treatment is same. Rest all the treatment is same. Okay. Now lease back. Lease back. Tell me guys, in the lease back what we do? In the lease back what we do? 10 annual lease payment of 15,000. Lease payment interest rate is 5%. Discount rate is 7.72. So what is the lease liability? 115,000 multiplied by 7.72. It is 887800. It's an annual lease payments paid in advance or arrears. Just have to check that. Zuno will make 10 annual lease payments of 15,000. Nothing said, so I will assume it to be arrears. Okay. Now this is your lease liability. This is your lease liability. This is your lease liability. Tell me guys, what is the ROU asset? So ROU asset is carrying amount multiplied by lease liability divided by fair value. What is fair value? 900,000. So this is your ROU asset. This is your ROU asset, right? So now what is the reversal? What is the reversal on leaseback? What is the reversal on leaseback? Come on guys, tell me what is the reversal on leaseback? So the reversal on leaseback is this much. 295,933. So what is the actual gain? What is the actual gain or loss? What is the actual gain or loss on sale and leaseback? So understand, on sale you recognized a gain of this much. On leaseback you had a reversal of this much. So the actual gain is 4067. So now what is the journal entry to record this one? What is the journal entry to record this one? Say this sale and leaseback thing. So I can say this one. We will bank account debit to asset. Here I will write here ROU debit by amount of this one. Then I will say here to lease liability credit by amount of this one. Okay. So now the differential figure will be how much? Is equal to this plus this minus this minus this minus this is 4067. This is what I calculated here as well. I believe it is clear to all of you. The whole story revolves around this line. The whole story revolves around this one. The whole story revolves around this one. Is it clear, everyone? Come on guys, please tell me. Is it clear to all of you? Chalo. So now moving on to the next topic. So we have done sale and leaseback done. Okay. Now sale and leaseback is done. Now we are moving on to the next accounting, that is Lessor Accounting. Just a minute, guys. Now, in Lessor Accounting, first of all, the lessor has to, point number one, the lessor has to classify. Whether the lease contract is operating lease or finance lease. Okay. Now, based on multiple factors, but the whole intent behind that is whether the risk and rewards are transferred or not. So if the risk and rewards are transferred, then it is a case of finance lease. If the risk and rewards are not transferred, then it is an operating lease. But what is accounting treatment of operating lease and finance lease? So if I talk particularly about operating lease, in operating lease, we recognize the lease payments received as rent income in P and L, okay, at SLM basis. And I believe you already know the meaning of SLM basis. I already discussed it yesterday. The meaning of SLM, straight line method basis. That is, you do the average rental. You calculate the average rental and recognize that as an income rather than recognizing it as an actual basis. Okay. Now comes the question, point number 3. What is the accounting treatment of finance lease? For finance lease, what is the accounting treatment of finance lease? So let me explain finance lease. So in the case of finance lease, basically what we do here is just a minute. Okay. In case of finance lease, basically we first of all recognize lease receivables. At what rate? Understand, at present value of two things: future lease payments and unguaranteed residual value at implicit rate of interest. Okay. Can anyone tell me why are we not taking guaranteed residual value here? Can anyone tell me, guys? Come on, let me see who can answer. Me this question. Come on, guys. Why are we not taking guaranteed residual value here? Why only unguaranteed? Because guaranteed part is already taken up in the future lease payments. It already includes. Very good, Sankar. Okay. Now next, de-recognize the asset. Since we have already transferred the risk and rewards. Can we continue to recognize asset? No. De-recognize the asset at its carrying amount. Okay. And the difference, if any, is recognized in P and L. Now what will happen subsequently? Can you please tell me what will happen subsequently? You will unwind lease receivables and recognize what? Finance income. Is that clear, everyone? Come on, guys, tell me, please. Okay. Now the next part. What if, point number 4, finance lease in case of manufacturer or dealer, then what will happen? In case of manufacturer or dealer, how will the accounting work in that case? Manufacturer or dealer, how will the accounting work? Just give me a minute, please. Now, in case of manufacturer or dealer, okay, you will recognize revenue. You recognize revenue at present value of future lease payments. Okay. Now, you recognize Okay, you recognize cost of sales at carrying amount of asset minus present value of unguaranteed residual value. Then you recognize lease receivables. You recognize lease receivables at present value of future lease payments plus unguaranteed residual value. Sir, can you please help me with the journal entry here? Yes, yes, yes. I will definitely discuss. I'll definitely do that. Don't worry. Subsequently, it is the same. Subsequently, it is the same. Okay. Now, journal entry. Journal entries. So understand, please. Revenue. Lease receivables account debit to revenue. Credit by what amount? By amount of present value of future lease payments. Okay, now then lease receivables account debit okay to asset to revenue. Sorry, not revenue, cost of sales, right? Cost of sales account debit. Cost of sales account debit. Account debit to asset credit. To asset credit. Okay, now please understand one thing here, guys. Lease receivable will be recognized by present value of unguaranteed residual value. Asset you will de-recognize by its carrying amount on date of carrying amount of asset. You can say carrying amount of asset. Okay, and the difference, balancing figure, goes to cost of sales. Balancing figure goes to cost of sales. Balancing figure goes to cost of sales. Is it clear, everyone? Is it clear, everyone? Why inventory? Okay, so here you want to write asset or inventory, that is fine. Okay, I am writing asset. If you want to write inventory, that is also fine. That is also fine. That is also correct. Not an issue. But tell me, is the logic clear, everyone? Is the logic clear, everyone? Come on, guys, tell me, please. Is it clear, everyone? So this is how the accounting has to be done if the finance lease accounting has to be done in case of manufacturer or dealer. Is it clear, everyone? Okay. Now, one more concept is there. Let me take that up also. Sublease. 5. Sublease. Now, how do we account for sublease? Understand, please. For sublease, there are three parties. Please understand. There are three parties in case of sublease. One is ultimate lessor. Okay. Another is intermediate lessor. And then is ultimate lessee. So basically, ultimate lessor gives the asset on lease to intermediate lessor. Now this party again gives on lease to ultimate lessee. So now understand, ultimate lessor will apply lesser accounting. There is no challenge in that. We are not required to study anything further into this one. The ultimate lessee is also very clear. will apply, it will apply lessee accounting. Very simple. It will apply lessee accounting. Very simple. No challenge at all. It will apply lessee accounting. The challenge comes up with intermediate lessor. The challenge comes up with intermediate lessor. Okay, because here it is a lessee in the original contract capacity and then lessor in the sublease capacity. Okay, so it's a lessee and a lessor both. So first of all, here he will have to apply lessee accounting, and recognize lease liability and ROU. Apply lessee accounting and recognize lease liability and ROU. Okay, then in capacity of lessor, okay, so you have to first of all classify the contract as operating lease or finance lease. Now on what basis, how will you compare, how will you say that it is an operating lease or a finance lease? So compare sublease term with head lease term, okay. Now if substantial, then finance lease, else operating lease. Okay, now if it is operating lease, then if it is classified as operating lease, then in that case recognize rent income in P and L at SLM basis. If finance lease, then recognize ROU asset and recognize lease receivables and difference to P and L. We do not have any practical question on this one. Tell me guys, is it clear everyone? Come on guys, tell me. Clear everyone? Sublease clear? Sir, what if, for example, we are the lessee for a building, but we went to give the building to someone for rental purposes? Then how will we account? So it will sublease. This is what we'll do. We have taken what if we are the so basically we have taken the building on rent. Okay, and then further giving on building to rental, right? Further giving it on rental. So it's a sublease accounting that will apply here. Okay, so when you take the asset on lease, you will recognize lease liability and ROU. Okay, then in the capacity of lessor, you will first of all have to classify whether it is an operating lease or finance lease. How will you classify that? So for that you have to compare what is the lease term of sublease and what is the lease term of head lease, means the original lease that we have taken the asset on lease. Okay, if it is substantial part, then in that case we have to recognize financial lease. If not substantial, then operating lease. The lease liability will continue to be there as it is, because it is our obligation to pay now. Even if we give the building on rental to others, but still it is our obligation to pay to our lessor. Still it is our obligation to pay to the lessor. Tell me yes or no. Let's suppose this is A, this is B, this is C. A gave the asset to B, B gave the asset to C. Okay, so now let's suppose it is financial lease. Okay, so A ideally, B here recognized ideally ROU to lease liability, and then finance lease. Now, when it is a finance lease, ROU is derecognized. Okay, ROU is derecognized, but still in that case, B has an obligation to pay to A. So lease liability will continue to remain as it is. Okay. Chalo. So with this we complete the leases chapter. With this we complete our leases chapter. Okay. Now we have completed two standards already. Now moving on to the next standard. A small one we can take up, or you need a break. Can we take up a small standard? चलो ठीक है. Take 5 minutes break. 5 minutes. 5 minutes. Not more than that. Manufacturer part not clear. Okay. So okay, ठीक है. Come here. Okay. Though I will not be able to go into the depth of it as of now, but still ठीक है. चलो, let us discuss it in a very simple terms. Okay. See, understand here, in the manufacturer, what we are doing is whatever amount that we are receiving from the lessee is recognized as revenue. Okay. Now, whatever is the cost of inventory, we are recognizing that as the cost of sales. Okay. Difference goes to P&L as the profit. Right. Now, whatever amount that is supposed to be received is called as lease receivable. Like for example, we record trade receivable. Right. Trade receivable, it's a trade receivable. We have to unwind this trade receivable to record finance income. That's all. Simple. It is as simple as that. Chalo, let's have a break of 5 minutes quickly, and then we'll resume back again. Come on, guys, back from the break. Come on, guys, everyone. Come on, everyone. Let's restart, guys. Let's resume, not restart. Resume. Let's resume back, guys. Come on. So now we are starting one of the very important standard for an SBR paper, from which I have seen almost in every single attempt. I have seen a question at least of 4 to 5 marks itself, but I have seen a question in every single attempt. Okay, I have seen a question. In most of the attempt, there is a question from employee benefits. Okay, now what is the meaning of employee benefits? What is the meaning of employee benefits? Okay, so employee benefits basically means any benefit paid to the employees, and the simple treatment, please understand the simple treatment. Okay, you have to, whatever benefit that you pay to employees, recognize as employee benefit expense. Okay, recognize as employee benefit expense. Just a minute, guys, sorry. Recognize as employee benefit expense. If not paid, okay, if you have not paid the amount, recognize it as liability. Okay, now this it will be a current liability. If paid within 12 months from end of reporting date. Okay, now if paid beyond 12 months, then non-current liability. Now understand, current liability is not to be discounted. It is not to be discounted, and but you can say, but whereas non-current liabilities are to be discounted. They have to be discounted. Okay, now we have to study a lot. We have to study short-term benefits. We have to study you can say defined post employment benefits. We have to study termination benefits. We have to study long term benefits. But now I will be focusing from an exam perspective. Now I will be focusing strictly on exam benefit. Okay, now understand, for short term employee benefits, just tell me, guys, come on, for short term employee benefits, we recognize expense and provision. Okay, simple. Now coming to post employment employee benefits, they are of two types. Tell me what are two types. Defined benefit plan, and B is defined contribution plan. Defined contribution plan, right? Defined benefit plan and defined contribution plan. Right, now tell me, what is the meaning of defined benefit plan? Where a fixed benefit will be paid to employees on retirement. Okay, what is the meaning of a defined contribution plan? A fixed amount will be contributed during their employment a fixed amount will be contributed to a fund to a fund during their employment, which will be transferred to employees account on retirement. Are you understanding the difference between the two? Are you understanding the difference between defined benefit plan and defined contribution plan? All of you, come on, please tell me, guys. Are you understanding the difference between these two? Is it clear? The difference is a difference. A fixed benefit will be paid to employees on retirement. A fixed benefit will be paid, okay, for which for which okay, a required amount will be contributed to a fund during their employment. So now the focus here is fixed benefit. The focus here is fixed amount will be contributed. Okay, now here the contribution is of required amount. Whatever is the amount required to pay this fixed benefit, whatever is the required amount to pay this fixed benefit, okay, is it we will be contributing. But here in defined contribution plan, we will be just contributing a fixed amount. Now whatever is the amount that is there in the redemption doesn't matter. Okay, now let me take you an example. Take an example. Let's suppose we say that we have to pay to the employees on retirement 1000. Okay, now to meet this 1000, how do I need to allocate the funds during the employment? This is fixed. This amount is fixed, that whatever amount I have to pay on retirement is fixed. Amount to be paid on retirement is fixed. Now to meet this, I will have to decide what is the amount that I need to contribute today. Okay, now this is called as defined benefit plan. But in defined contribution, we say I will be contributing 100 every year. I will be contributing 100 every year. Now I will be contributing 100 every year. Now amount to be paid on retirement, I don't know what is the amount that I'll pay on retirement. Okay, whatever is the value of this fund at the time of retirement, I will give that amount. I will give that amount to the employee. I will give that amount to the employee. Okay, every month 1000, or how it is these amount of defined contribution plan is paid as a percentage of the salary that you give. Okay, example, a provident fund. Okay, a percentage of the salary every month. Now, okay, so now termination benefits and yeah, this one we'll discuss later on, but first of all let me discuss defined benefit plan and defined contribution plan. Okay, let me discuss this one now. I am discussing now defined benefit plan, the favorite topic of the examiner. Defined benefit plan. I believe all of you know that this topic is quite very important from an exam perspective. Okay, now let us discuss this topic now. Defined benefit plan. Now what are the components of the defined benefit plan, right? So it is called as present, because since it has to be paid at the time of retirement, it's a non-current, so it has to be discounted, right? So we record present value of defined benefit obligation, right? Understand? Or I'll show it to you. I'll show the chart only. Just give me a minute. Please see the chart. How does it move? Please understand, guys. I'll explain this in depth and you need to understand, because it is quite very important from an exam perspective. Okay, I'm explaining this in depth. insert table. Guys, I believe you know that defined benefit plan can be of two types. Defined benefit plan can be of two types. One is funded scheme. Another is unfunded scheme. Okay, what is the meaning of funded scheme? What is the meaning of funded scheme? Where we invest in plan assets. Where we invest in plan assets. Tell me yes or no. I believe you are aware of it. Now, no such investment. In case of unfunded scheme, we don't invest in plan assets. We don't invest in plan assets. Strike through. Okay. Now, what are the components of funded scheme and unfunded scheme? Let us understand what can be the components. Okay. Just a minute. Just insert column to the left. Let me delete. Particulars. Tell me guys, the elements, plan assets, the asset where we invest the amount of obligation. Guys, one request. This is a revision session, so I will not be able to go into the depth of any topic. Okay, these sessions cannot be a substitute of the regular classes. This is we assume in these sessions we assume that you already have studied it at least once. Okay, we will definitely assume that you have studied at least once. You have studied the topics. Okay, point number one is current service cost. Current service costs. Now tell me, what is the entry for current service cost in funded scheme and unfunded scheme? Come on guys, tell me. So current service cost is the cost for the current year, the present value of the cost for the current year. So it will increase your liability. It will increase your liability. It will increase your liability. Okay. Or let me first of all write all the components and then we'll write. Okay. Opening, then plus interest, then current service cost, then contribution to plan, then benefits paid, then you can say benefits paid done, contribution done. Okay, past service cost, past service cost. Can you tell me what is the meaning of past service cost? Change in liability, change in obligation due to amendment in plan. Okay, now then comes up remeasurement gain or loss. Then comes up curtailment and settlement. Then comes up ceiling adjustment. Okay, so these are the components. There cannot be any component outside this one. That's all. These are the only component that we have. Now understand what is the treatment of it. Okay, interest costs. So interest. Okay, now net interest cost. Interest costs account debit to present value of defined benefit obligation. Where will we record this interest cost? P and L. Okay, now same. Current service cost. So it will record it as current service cost, that is employee benefit expense as employee benefit. So I'll write here current service cost as CSC account debit to PVDBO. Okay, PVDBO means present value of defined benefit obligation. Okay, where will this employee benefit expense go? It will be recognized in P and L. Okay, so I will write here same. In whether it is funded or unfunded, the treatment is same in these two cases. Now contribution to plan. Okay, so contribution to plan will happen only if it is a funded scheme. Okay, so it will be plan asset account debit to bank. Okay, now in unfunded scheme, not applicable. Why? Because since there is no plan asset, we will not contribute, right? Now in benefits paid. Now tell me, when we pay the benefits to the employees, so definitely our obligation will reduce. But tell me, if it is a funded scheme, who will pay the benefits? Come on guys, tell me. If it is a funded scheme, who will pay the benefits? Plan assets. We will not pay. Plan assets will pay. But if it is an unfunded scheme, then who will pay? Then we have to pay. This is where it makes difference. Wherever there is a difference, I am highlighting that part also. Okay. Now, past service costs. Same. Okay. Curtailment and settlement. So curtailment means reduction of the liabilities. Settlement means to reduce the liability. What is the amount that we have paid to our employees? Okay, and here there will be a gain or loss on settlement. Okay, let's suppose the liability is reduced by 10, but to reduce the liability of 10, we have paid only 8. There is a gain of 2. To reduce the liability of 10, we have paid 13. So there is a loss of 3. So this gain or loss will go to P and L. It will go to P and L. Now how will things come up here? So here everything will be same, just that it will be to bank. Okay, so whatever is the difference between funded scheme and unfunded scheme, I am highlighting it in red. I am highlighting that in red color. Okay. Now, please understand. Remeasurement gain loss. Now, what is the meaning of remeasurement gain loss? So, carrying amount of net obligation versus what is the fair value of net obligation as per latest actuarial assumptions. The difference is called as remeasurement gain or loss. Okay, it is also called as actuarial gain or loss. Okay, so this difference is recognized in other comprehensive income. Okay, now when I say net obligation, I mean to say PVDBO minus plan asset for this one. Okay, so we'll follow the net amount. Follow the net. Okay, but here if it is a unfunded scheme, then what will happen? If it is an unfunded scheme, in unfunded scheme we do not have plan asset, right? So it will be for PVDB only. For PVDB, carrying amount of obligation. fair value of obligation. Okay, difference will be recognized in other comprehensive income. Is that clear, everyone? Is that clear, everyone? Carrying amount of obligation. That's all. Is it clear, everyone? Okay, now ceiling adjustment. Now, what is the meaning of ceiling adjustment? What is the meaning of ceiling adjustment? So please understand, ceiling adjustment doesn't come up here. Ceiling adjustment doesn't come up here. So standard says that whenever you have a plan asset, okay, you record, whenever standard says that if it is a funded scheme, recognize net amount, in SOFP. Recognize net amount in SOFP. Now please understand, in SOFP you recognize the net amount. Now there can be two situations. Case 1, you have a net obligation. Net obligation means your liability is more, meaning thereby your obligation is more than your plan asset. So in this case, do you need to test any ceiling adjustment? No ceiling adjustment test needed. No ceiling adjustment test is needed. Okay, but case 2, if it is a net asset situation, whereby the obligation is less than a plan asset, so it's a net plan asset, your investments are more, meaning thereby even after settling all the obligation, you will still have some asset, you will still have some surplus in your investments. Then standard says that in that case you will say what is the fair value of net asset? What is the fair value of net asset? Okay, you compare this. Okay, so you're right. If fair value of net asset is greater than, or I can say fair value of, okay, greater than fair value of refunds, then record the difference as ceiling adjustment. Now, what is the meaning of this? Let me explain with the help of an example. Okay, now understand, guys. Carrying amount of net asset is 100. Okay, now fair value of net asset is 120. So what will you say? It is an actuarial, it is a remeasurement gain. Of 20, which you will recognize in OCI. Tell me yes or no. Which you will recognize in OCI. Tell me yes or no. Come on, guys, please tell me. Is it clear, everyone? Is this clear, everyone? Okay, now what is the meaning of this fair value of net asset? Means even after settling the liability, you will have a surplus of 120. So now the standard says that, now question says that, okay, surplus of 120 means even after settling all the obligation, 120 will be left in the plan assets in my investments, which will come to me as refunds, as a refund. Okay, so now it says fair value of expected refund is 130. Tell me, what will be the treatment? What will be the treatment? Point number 1. Come on, guys, tell me. If the fair value of expected refund is 130, what will be the treatment? So you are saying you have a surplus of 120, but you will get a refund of 130. Means this 120 is fully recoverable. This 130 is 120. This 120 is fully recoverable. So you will. There is no ceiling adjustment to be done. There is no ceiling adjustment that has to be done. Now, second example. Please understand. If the fair value of expected refund is 105, if the fair value of expected refund is 105, okay, then you are saying you have a surplus of 120, but the question is saying, okay, you will get a refund of 105 only. You will get a refund of 105 only. Now you have to record a ceiling adjustment of 15. It is a loss. It is a loss. It is a loss. Okay, and this will be recognized in other comprehensive income. Is it clear, everyone? Is it clear, everyone? Is it clear, everyone? I believe I have explained the defined benefit plan like nothing more than that can be done. Tell me, guys, is that clear, everyone? Is that clear, everyone? Come on, guys, please tell me. Okay, now one thing, I just again, just a minute, right? I'm getting an urgent call. So what I'll do here is I have a question. I have a question for you guys. Okay, just you guys try this question. You guys try this question, and I will be back in just 1 minute. Can you see this question on the screen? Can you see the question on the screen? Based on what we have studied now, this is the question exactly from that what we have studied so far. Okay, this is the question. So now one question you guys solve it now, and one I have one more question. This is a question with ceiling adjustment, which this I will be solving with you guys. So can you please try? Can you please try for 5 minutes? I'll be back quickly. I'll be back quickly. Can you please try till then? So here I am, guys. Okay. So were you able to solve this question? Come on, guys, tell me. Were you able to solve this question? Come on, guys. Come on, come on, come on, come on, everyone. Were you able to solve this question? Okay. Chalo, let's quickly read the question and solve it. Okay. Now, Tulip operates a defined benefit plan for its employees. The following information is relevant for the year ended. The fair value of the plan assets at opening is 13.95. Present value of the obligation or opening is 15.1 million. So it is a net obligation situation. Okay. Now 15.1, I will take the figures in thousands. I will take the figure in thousands. So I'll say 15,100 and I'll say here 13,950. Okay. So the net obligation, it is a net obligation. It is a net obligation. Okay. Now further, Tulip made a contribution of 480. Contribution means it will increase my plan asset by 480. It will increase the plan asset. Okay, now current service cost is 465. So it will increase the current service cost 465. Okay, then benefits paid out 370. So benefits paid out will be adjusted from both PVDBU and plan assets. So minus 370 minus 370. Okay, done. Fair value. Okay, now interest rate is how much? 8%. Interest rate is how much? 8%. At the opening and closing is 7%. So we'll take the opening one, right? So it is this multiplied by 0.08. Now done. So now this is the carrying amount of the net obligation. The carrying amount of the net obligation is 1227. Carrying amount of the net obligation is 1227. Okay, now what is the fair value of the net obligation? Can you please tell me, guys? Come on. So fair value is given in the question. 15.08 and 16.62 million. Okay, so it's 16.62 minus 15.08. So let's write here 16620 obligation minus 15080. This is 1540. So carrying amount is this much, fair value is this much. So this is a gain. So it is a remeasurement gain, not loss. It's a remeasurement gain, which will be recognized where? Other comprehensive income. Okay, so just to understand, this interest will go to P&L. Okay, this current service cost will go to P&L. Contribution will go to cash flow. Okay, now benefits paid, no impact because we are not paying the benefits. The benefits are being paid by the plan assets, right? So this will go to SOFP. Okay, this remeasurement gain will go to other comprehensive income. Is that clear, everyone? Is that clear, everyone? Okay, always remember, guys, whenever a question like this comes up in the exam, always solve using this tabular format. Always solve using this tabular format. Okay, using this tabular format. Now, one more question. This question was earlier in one of the technical article, but that technical article got deleted. Okay, but now what ACCA did is they deleted the technical article but included this example in the study hub. Okay, so this example is coming from the study hub. Guys, just 1 minute. I think there is one small point. Your obligation is increasing. It's a remeasurement loss. My bad. It's a remeasurement loss. My bad, guys. My bad. It's a remeasurement loss. Sorry, my bad. Okay, it's a remeasurement loss. Now coming to the ceiling. Adjustment question. Okay. Now it's a question of similar type, but let us solve the question. Now, please read and understand and solve. Okay, Apollo & Company manages a defined benefit scheme for its employees. Okay, At 1st January 2008, the fair value of the pension scheme assets was 137 and obligation was 122. So if you can see, assets is more than liabilities. Assets is more than liabilities. It's a net asset situation. So see, since it's a net asset situation, assets are more. I have changed the structure of the table. I have written the plan assets first, and then PVDBO, and then ceiling, and then net. Okay. See, in this question it was PVDBO. Sorry. In this question it was PVDBO minus plan assets is equals to net obligation. Why? Because in the case of net obligation there is no ceiling adjustment that is there. Is that clear, everyone? Is the structure clear, everyone? Now, plan assets initially is 137. PVDBO is 122. Okay. So the net asset comes to 1. The net asset comes to 15. But the question goes on to state that the asset ceiling has been calculated at 14. Okay. So understand, this was 15. Expected value of refunds is 4. So you will have to record a loss of 11. You will have to record a loss of 11. The question is not visible, is it? I think, guys, is the question visible to all of you? Can you guys see the question? Can you guys see the question? Can you please confirm the chat box, everyone? Come on, everyone. I can see the energy going down, guys. Guys, come on, everyone. Arey Baba, I will explain everything. First of all, show me the energy in the class. Visible, na? And how's the Josh? Everyone, come on. How's the Josh, everyone? Show some energy. Yes. Hi, sir. Okay, come on. So the question says that, understand, please understand. Question says that your net asset is how much? 15. Understand what does the question say? Question says the net asset is 15. Okay. Fair value of net asset is 15. Now, further the question says ceiling, meaning thereby ceiling means fair value of expected refunds. Ceiling means fair value of expected refund is how much? 4. So tell me, what is the ceiling loss? What is the ceiling loss that you will record? 11, right? And your net asset will be recorded at 4 in your SOFP. This ceiling loss will go to other comprehensive income. Tell me, is it clear now? Is it clear now? Okay, but this is opening, guys. This is opening. Okay. Thank you, guys. Thanks for so much of appreciation. I love you guys too. I love you guys. Okay. This is all for my ACCA students. Okay. Keep enjoying the session. Keep studying. Okay. Now, again, coming back to the studies. Now, understand, guys. What does it say? The discount rate on the high quality bonds is 4%. So discount rate is interest rate is 4%, right? So interest rate is how much? This into 0.04. Okay. Now, interest also we have adjusted. Now, let us find cash contribution 7. Tell me where will we adjust cash contribution? Plan assets 7. Benefits paid 6. So -6. Okay. Current service cost 5. So current service cost will come up here. All done. Anything else? Now, let's read the question further. But the ceiling has been is to be calculated at year end. Yes. So in the previous year and also we would have calculated the ceiling now. This is what it is. This is for the previous year. This ceiling is what we have done in the previous year. Okay. Now, during the year, there was a scheme curtailment which resulted in a gain of settlement 3 million. Okay, gain on settlement. Okay, meaning thereby our liability reduced by 3, but for which we have not paid anything. Okay, so I can say minus liability 3, liability reduced by 3, for which we are not required to pay anything. Okay, now because it said no, we have done curtailment. Okay, which resulted in a gain of 3. So this is our net asset. This is our net position. This is the net carrying amount of the net position, which is net asset of 9.16. Which is a net asset of 9.16. What is the fair value? Can you please tell me? What is the fair value? Can you please tell me? See, fair value of the asset is 148 and liability is 136. So fair value is 148 minus 136. 12. There is one student who is saying, please make this session 24 hours long. We don't want to go away from the session. It is a great appreciation for me. But yes, as I mentioned to one of my students also today, I was mentioning in a group, I am a human being. I am not Rajnikant. Okay, chalo. Now, so net asset is increasing from 9.16 to 12. It's a remeasurement gain or a loss. Tell me, it's a remeasurement gain or a loss. From 9.16 to 12, the asset is increasing. So it's a remeasurement gain. Which will be recognized in other comprehensive income. Now, further, the question also goes on to state the ceiling. Yes, here it is. The ceiling is here. See, at the year end, the ceiling is calculated at 11 million. At year end, the ceiling is 11 million. Fair value of refund is 11 million. Right? So you have a net asset of 12 and you expect a refund of 11, meaning thereby there is a ceiling loss of 1 million, which will be recognized in other comprehensive income. Okay. Now tell me, guys. Okay, what if the ceiling is 14? If the question says rather than 11, the ceiling is 14, then what will happen? Tell me. If the ceiling is 14, then what will happen? Tell me, guys. If the ceiling is 14, then what will happen? Will I recognize a gain of 2? Ceiling gain? No, I will not recognize a gain. No treatment. Simple. No treatment. Okay, if it is 11, a loss of 1. If it is 10, a loss of 2. If it is 8, a loss of 4. Okay, if it is 12, no loss. If it is 13, no loss. If it is 14, no loss or no gain. If it is 15, no gain, no loss. Are you understanding the concept of ceiling now? Come on, guys, please tell me. So can I say it like this? Please understand. Crux of ceiling. Carrying amount of net asset versus fair value of net asset will give you remeasurement gain or loss. It can be gain or loss and it will be recognized in other comprehensive income. Now, further, fair value of net asset, if it is more than the ceiling, okay, or I can say if ceiling is less than fair value of net asset, then recognize ceiling loss in OCI. Ceiling, do you know what is ceiling? It's an impairment. It's an impairment. It's an impairment. Now, but if understand, guys, if ceiling is more than fair value of net asset, then ceiling gain. No, this is not the case. This is not the case. Right. I believe it is clear to all of you. Come on, guys, tell me. Is it clear, everyone? Is it clear, everyone? Come on, guys. Come on, everyone. Tell me. Is it clear, everyone? Is it clear to all of you? Okay. So let me highlight this part. Okay. Chalo. Now comes the next part, that is termination benefits and long-term benefits. So now for long-term benefits, I can say the treatment. Okay, we have defined contribution plan also pending, right? So defined contribution plan, the treatment is recognize expense as and when paid. Recognize expense as and when paid. Okay, now when I can say accrued, when accrued, okay, and if not paid, recognize a liability, but since it has to be paid within 12 months, it will be a current liability. Okay, now long-term employee benefits. So for long-term employee benefits, I can simply say treatment of long-term employee benefits is same as defined benefit plan. Okay, however under long-term employee benefits, okay, this one, remeasurement, gain or loss, and ceiling loss is recognized in P&L rather than OCI. Okay, now what is termination benefits? So termination benefits, simple this statement again. Tell me, is it clear, everyone? Is it clear, everyone? So we have studied short-term employee benefits, defined benefit plan, defined contribution plan, long-term employee benefits, and termination benefits. Everything is discussed. With this we come to an end of employee benefits chapter. Is that clear to all of you? Come on, guys, please tell me. Is that clear to all of you? Come on, guys, please tell me. Just a minute. For notes, and pin. Okay, pin message. Chalo. Now the notes will be shared tomorrow, guys. Okay. Funded or unfunded is a choice that the entity has. Okay. Now, moving on to the next standard. Moving on to the next standard. IFRS 2 share-based payments. IFRS 2 share-based payments. Okay. Now, yes, I'm trying for the to include the practice sums as well. Okay, so that you can practice these sums on your own as well. I'm trying for that. Okay, chalo. Guys, come on, everyone, be active in the class. Okay, chalo. Share-based payments. Now, the share-based payments are of two types. The share-based payments are of two types. Are of two types. What is? It is equity settled. It is equity settled and cash settled. Okay, now let me discuss. First of all, equity settled. Yes. Now, Prakshal Mehta is asking, sir, will you help revise SBR group accounting? Yes. So SBR group accounting, I will be helping you revise today. Okay, but only from the concept part I will be revising. Okay. Now, sir, what about question practice? I have already taken a session of question practice, the detailed session of question practice. I have already taken up in the last week. I have taken it YouTube live. For the students who have joined, they would know about it very well. Okay, I have already taken it up. So I think taking it again and again doesn't make any sense. But yes, I have drafted few examples. Which definitely I'll be discussing. See, foreign subsidiary, foreign associate, disposal. These examples I have drafted for group accounting, which I'll discuss. Okay, now chalo guys, come on, let's stick to what we are discussing. Vidhi, that is FR related na. Okay, ठीक है. Since you guys are asking, let me show it to you. See, the one which is FR related is here. Okay, it's a conceptual revision. The one I'm talking of SBR is here. SBR practice group accounting. Can you see this question video? Can you see this video? SBR group accounting question practice. It was taken just 3 weeks ago. On 1st of Feb, I have taken this one. I have taken this on 1st of Feb. Okay, so you can very well watch this session. For SBR group accounting concept based practice. And trust me, guys, the questions which I have practiced in that session, the questions which I have practiced in this session, in this session, okay, SBR practice group accounting, they are amazing ones. For those who have joined the session, they will very well know about it. If there is anyone, any student who has joined that session, can you please share a feedback of that in the comment box? Now, equity settled. Okay, now in equity settled, tell me, the accounting is done on the basis of fair value at grant date. Okay, now tell me one thing. Any subsequent, can you see the notes? Can you see this? Whatever I'm writing, can you see it? Yes, I think you can see it. Okay, let me just quickly come here. Just a minute, guys. Now, any subsequent fair value changes. Tell me, if it is equity settled, tell me, do we account for any subsequent fair value changes? No. No treatment. No treatment. No treatment. No treatment. Okay. Now tell me, what is the journal entry? What is the journal entry? The journal entry that we pass at each journal entry at grant date. Tell me, what is the journal entry that we pass at grant date? So at grant date, since we have not received the services, nor we have to give any shares, right? No treatment. No treatment. Right? Now, journal entry at each reporting date. At each reporting date. Tell me, what is journal entry at each reporting date? It is employee benefit expense account debit to SBP reserve. To SBP reserve. SBP reserve is recognized as part of other equity in SOFP and in SOFP other equity, and its employee benefit expense is recognized in P and L as an expense. Is recognized in P and L as an expense. Is it clear, everyone? Is it clear, everyone? Now, journal entry at settlement date. What is journal entry at settlement date? So at settlement date, what we write here is SBP reserve account debit. Okay, bank account debit. SBP reserve account debit, bank account debit to equity share capital on the basis of face value. On the basis of face value, number of shares multiplied by face value, okay, to securities premium or share premium. Okay, now balancing figure. Now, so this is how we account for equity settled. Now, one more thing which I want to highlight here is whenever you calculate option expense to be recognized in P&L, how do you calculate option expense? Can you please tell me? How do we compute option expense? Can you please tell me, guys? How do we calculate option expense? So it is number of employees multiplied by number of options per employee multiplied fair value on grant date multiplied by expired period divided by total vesting period. Okay, now one thing please understand, minus expense already recognized. So this is how you calculate the option expense. Now please understand one more point here is the number of employees is calculated on the basis of best estimate of employees, who will exist on reporting date. Is that clear? So this is all about equity settled. Now let us talk about cash settled. Now what I have done is I have written equity settled. Okay, and I will just be making changes so that you understand. Now tell me, in cash settled, do we take fair value at grant date? No, we take fair value at each reporting date. Any subsequent changes? Yes. For any subsequent fair value changes, we will remeasure the liability. And recognize expense in P&L. Okay, now journal entry at grant date, definitely no treatment. At each reporting date, employee benefit expense account debit to, is it SBP reserve? No, it is called as provision for stock appreciation rights or share appreciation rights. It is recognized in SOFP as non-current liability. Journal entry at settlement date is provision for SAR, stock appreciation rights or share appreciation rights, account debit to bank. Okay. Now option expense is number of employees multiplied by option number of options per employee, fair value at each reporting date. Okay. Now number of employees is to be calculated on the basis of best estimate of number of employees who will exist on the reporting date. Tell me guys, is it clear everyone? Cash settled and equity settled, is it clear everyone? Now fourth point. Now the next point is vesting conditions. So vesting conditions again are of three types. Okay. Point number one, it is service condition. It is performance condition, or it is market condition. Now service condition means you have to remain in service for this period. So in this case, we recognize expense over service period. Whatever is the service period, we recognize expense over that period. Okay, one point is coming up, but Khushi, can I take it up later on? Because I wanted to take it up. Okay, I'll take it up. Just hold on a minute. Though I wanted to take it up later on, but I'll take it up. No worries. Just give me a minute. Let me complete the vesting condition and then I will take up your point also. Okay. So in the service condition, we recognize expense over service period. In the performance condition, we recognize expense over actual vesting period. Meaning thereby, understand what is the meaning of actual vesting period. Let's suppose the performance condition means the entity says to the employees that if you increase the profitability by 20%, in the next 2 years, I will give you the shares of my company. Now what happens is, in the next 2 years, it is not reasonable that the employee will be able to increase the profitability by 20%. Okay, so but the employee say we can definitely do it within 3 years. Okay, so we have to record the expense over 3 years. So whatever is the estimated vesting period, okay, okay, we have to recognize the expense over that period. Okay, or rather than actual, I can say over estimated vesting period. Okay. Now market condition. What is the market condition? If the share price increases, market price of the company increases by this much percentage, I will give you the shares of my company. Okay. Now recognize expense over lower of estimated vesting period or actual vesting period. Now what is the meaning of it? What is the meaning of this line now? Understand. Let's suppose example. So company told to its employees, if the share price of the company goes up by 50% in the next 3 years, I will give you the shares of my company. I will give you 1000 shares of my company. Okay. Now what happens? Now the employees believe, now what happens? The share price goes up by 50% in the next 2 years itself. In the 2 years itself, the share price goes up by 50%. So what we'll have to do is, in that case, we have to recognize the expense over 2 years. But let's suppose the share price goes up by 50% in the 4 years. estimated vesting period was 3 years. Okay, but it went up, this market price went up by 50% by in 4 years. So in that case, standard says that you have to recognize the expense over 3-year period only and not 4 years. So basically it means entity can prepone expenses but not postpone. It cannot postpone. Okay, it cannot postpone the expenses. Okay, now this is about vesting condition. Now one more point in cash settled, guys. In cash settled, one more point. Whenever the cash settled has to be settled, the settlement of cash settled share based payment is done at its intrinsic value. Okay, now any gain or loss on settlement is recognized as an expense in P&L. Now one more point here. Okay, if after vesting period or vesting date, but before exercise date, fair value changes, okay, entity will remeasure the liability and recognize gain or loss to P&L. Is it clear, everyone? Is it clear, everyone? So with this, this part is also done. Now one more part, the next part of share based payment chapter is the most important part, is share based payment with settlement alternative. Okay, and counterparty has the choice of settlement. Very important topic, right? Share based payment settlement alternative, meaning thereby employees, I have given the option to the employees. If you want cash, I will give you cash. If you want equity shares of my company, I will give you equity shares. You have the choice how to do the accounting in this case. So now for this, I have taken up an example to explain. Okay, let me explain this with the help of an example. Here we go. This is the example. Okay, chalo. Now it says on 1st July 20x1, the grant date, the company grants an employee a right to allow them to choose to receive either 20,000 shares on 30th June 2004 or cash equivalent of 18,000 shares. Okay, now tell me, which one we have an obligation? If the employees asks for cash, can we avoid paying it? No. So there is a contractual obligation to pay cash. It's a financial liability. So what do we do? It's a financial liability. So we have to record the entire amount of financial liability. Okay, we have to record the entire amount of financial liability. So now what we have to do is, on the grant date, in this case, we will find the value of equity alternative and we'll find out the value of cash alternative. Okay, first of all, we'll find out the values. Okay, now if it is equity alternative, we will have to give 20,000 shares, and if it is cash alternative, we have to give 18,000 shares. Now, what is the fair value of equity alternative? The fair value of the share root, the fair value of the share root is 4.90. So it is 4.90. Now the fair value for cash root will be market price of the share is $5 at 1st July 20x1. So it is 5. So multiplied by 5. Multiplied by 5. By 5. 90,000. So now we have to definitely record cash alternatively. Cash alternative, we have to record the cash alternative as it is. We can't touch it. Why? Because we have an obligation to pay. Because we have an obligation to pay. Now equity will be accounted for the differential amount. Equity will be accounted for the differential amount as 8,000. Now please understand, guys. Okay, equity alternative is more than cash alternative. Hence, we have recorded the excess of equity as equity. What if the equity alternative would have been 85,000? Then in that case, will we record equity as negative 5,000? In that case, will we record equity as negative 5,000? Tell me, will we record equity as negative 5,000? No, equity can be 0. Equity can be 0 but not negative. It can be 0 but not negative. Okay, it can be 0 but not negative. So in that, if this is the situation, we will not record any equity expense or equity and corresponding expense. We will not be recording it. Okay. So now, since equity is more, then whatever amount is the excess, we'll record that in equity. Okay. Now, but tell me, on grant date, do we need to record anything? No, we are just doing assessment. We are just doing assessment. We are not recording anything on grant date. We are not recording anything on grant date. We are just doing assessment. Okay. Now, on 30th June 20x2, that is the reporting date, what will happen? We will record employee benefit expense to SBP reserve to provision for SAR, share appreciation rights. Now, what is the provision for SAR that we have to record? Okay, cash alternative, we will get a cash value of 18,000 shares. Now, 30th June 20x2, what is the fair value? The fair value is 5.35. So multiplied by 5.35. What is the this one? Vesting period x2, x3, x4, 3 years. So into 1 by 3 is 32,100. Now for equity, what is the value? 8,000 divided by 3. So what is the total expense? This plus this is your total expense. Is that clear, everyone? Is that clear, everyone? Now, SBP reserve again, this by 3. In provision for SAR, 18,000 multiplied by, what is the fair value on 30th June 20x3? 5.8 into 5.80 into 2 by 3, because 2 years has already passed. Now we have to reduce the expenses recognized earlier. Okay. Now, so what is the total expense? This plus this. Clear. Now, third year end, what will happen? Again, share based payment reserve by the same amount, because it is taken on the basis of fair value at grant date. So the values will not change here. The values will not change here. Here it will be 18,000 multiplied. What is the fair value? 6.1. Okay, multiplied by 3 by 3 minus, what is the expense already recognized? Year 1, year 2 is 40,200. So what is the total expense that will go to P&L? This much. So now tell me please, in provision for, in share based payment reserve, you have a balance of this much. Provision for SAR, you have a balance of this much. In share based payment reserve, you have a balance opening plus expense for the current year. Provision for SAR opening plus provision for the current year, share based reserve opening plus expense for the current year. Okay, provision for SAR opening plus provision for the current year. Okay, so this is the cumulative balance which is there in the share based payment reserve, and you can say provision for SAR. Now what is the treatment? Now we have to see, we have to ask employees, tell me, what do you want, cash or shares? What do you want, cash or shares? Okay, so now I will explain both. On vesting date, if they ask cash, then what will I do? Provision for SAR account debit, I will pay at intrinsic value. Whatever is the intrinsic value, I will pay at intrinsic value. Now, sorry, I will pay at intrinsic value to bank. I will pay at intrinsic value, credit. I have recognized 109800. The difference, if any, will go to employee benefit expense, that is P and L. Okay, now what if the employee asks for equity shares? Then please understand here in cash, one thing more. What about share based payment reserve? So this share based payment reserve will now be transferred to retained earnings. Okay, debit credit. If it is cash, we pay the cash, and share based payment reserve has no value now, so it will be transferred to retained earnings. Now if the employees demand equity shares, then SBP reserve account debit, provision for SAR account debit, amount, tell me please, 8,000, and this amount is 109880. Now we issue equity shares. Okay, now how many equity shares to be issued? 20,000, right? So 20,000 using a face value of $1 to the difference will go to share premium credit. What is the amount? It is this plus this minus this. Is it clear, everyone? Is it clear, everyone? Is it clear, everyone? Okay, wonderful. So with this we complete the share based payments as well. Now moving on to the next topic. Done. Refer Excel file right here. So I'm covering only from an exam perspective. Whatever are important, I'm covering all the points. Whatever are important, I'm covering all the points. Chalo. Now coming to income taxes. Okay, before income taxes, can we take a break now? Shall we take a break of 10 minutes now? I think we can take a break of 10 minutes now. I think we have studied properly. We can take a break of 10 minutes now. All of you? Do you guys need a break? Come on, guys, be active in the class. Why so dull? I am not liking this, guys. I am not liking this. Yesterday the energy was quite very high. Yesterday the energy was quite very high. Oh, I can't see that energy today. All of you. Okay, chalo, let's take a break of 10 minutes and then we'll resume back and we'll study income taxes. We have to study income taxes. We have to study IFRS 18. We have to study group accounting. We have to study IFRS 19. We have to study operating segments, right? So these many we have to study still. Come on, guys. Let's resume back. And we are starting one of the easy but important from an exam perspective chapter, income taxes. Come on, guys, tell me. How's the Jose, everyone? Come on, everyone. Come on, guys, tell me. Everyone, back to the class. Everyone, back to the class. Come on, guys, tell me. Now, income taxes is a chapter which we have already studied yesterday. We already revised it yesterday. Let me give you a quick refresher. Okay, let me give you a quick refresher of it. Guys, can you listen to me? Can you please confirm if you can listen to me? Audio, video clear, everyone? I love the energy of you guys. I love the energy. Okay, so please keep showing the energy in the chat box, and you can see a reflection of that in me also. Okay, so please keep the energy high. Please keep the josh high in the class. Okay, now, so we have already studied income taxes yesterday. Now, income taxes in SBR is particularly testing your knowledge from a deferred tax perspective and not more from a current tax perspective. Okay, now, understand, guys, please. Okay. So in yesterday we studied how to arrive at the deferred tax thing. So we have to compute carrying amount of the asset or liability. We have to compute tax base of asset or liability. Okay. Now considering carrying amount and tax base, we need to compute temporary difference. We need to compute temporary difference, that is TD, as carrying amount minus tax base. Okay, now this temporary difference has to be classified as taxable temporary difference and deductible temporary difference, right? Now please understand, now taxable temporary difference multiply with tax rate multiplied with tax rate. Now how to classify as taxable temporary difference, deductible temporary difference, we have already discussed in the last class. Okay, now taxable temporary difference multiplied by the tax rate gives us deferred tax liability. Now deductible temporary difference multiply with tax rate gives us deferred tax asset, but subject to prudence limits. Now, what does the prudence limits say? What does the prudence limit say? With this, we come to our first topic of the day, that is concept of prudence. Concept of prudence. So concept of prudence. Now please understand, what is the meaning of concept of prudence? So concept of prudence means, say, deductible temporary difference means it will reduce future taxable profits. But what if in the future there is no taxable profit itself? Then what will we do? What if in the future there is no taxable profit itself? Then what will we do in that case? Then the standard says, that if that is the case, let's evaluate the prudence limits. Okay, now standard says that for deductible temporary difference, you can recognize that as a deferred tax asset if, so I'm writing here, deductible temporary difference can be recognized as deferred tax asset if either of the following is met. Any. What? Point number 1. Okay, sufficient taxable temporary difference, okay, is expected to reverse in the same year in which deductible temporary difference are either expected to reverse or can be carried forward. Now, what is the meaning of it? What is the meaning of it? Please understand, guys. What is the meaning of it? Please understand what is the meaning of it. Now, the standard clearly says, very simple. Standard says it very simple that, okay, let's suppose, assuming you don't have any profit, because tell me, can we estimate that what is the profit that I will be making in the future? What is the profit that I will be making in the future? No, because even if I estimate the profit, there is a high level of uncertainty involved. So now the standard says that see, taxable temporary difference will increase taxable profits. Now, taxable temporary difference will lead to tax liability. Now, in that year itself, you will get deductible temporary difference. So you can get the benefit of deductible temporary difference by adjusting it against taxable temporary difference. Okay. Or there are future taxable profits available. It is certain that future taxable profits will be available. Okay. Or if there are any tax planning opportunities available, in that case, if either of the three are existing, we can say that we can recognize deductible temporary difference as deferred tax asset. If none of the above exists, then do not recognize deferred tax asset. Okay. And disclose the temporary difference as unrecognized temporary differences. Okay. Now this is what it says, concept of prudence. Simple. Okay. Now moving on to the next point, that is share-based payments. Moving on to the another point, it is share-based payments. Now for share-based payments, guys, come on, understand. Share-based payments are of two types. We know equity settled, cash settled. Cash settled, we recognize liability, so we can calculate very well the carrying amount of liability, tax base of liability, temporary difference, and hence we can continue to recognize a deferred tax asset or deferred tax liability for the same. Right? There is no challenge at all. Coming to equity settled. So equity settled, we know the carrying amount of SBP reserve, but do we know the tax base of SBP reserve? Tell me. Do we know the tax base of SBP reserve? Tell me, guys, come on. Do we know the tax base of SBP reserve? No, we don't know how to calculate the tax base of equity. We don't know that. Okay. So now the standard says that in case of share-based payment, equity settled. In case of equity settled, share-based payments recognize deferred tax asset on the basis of future deductions. Now tell me, what is the future deductions? Future deductions is based on intrinsic value. When at the time of exercise of options. So basically in our accounts books, we keep on recognizing the expense over the vesting period, right? So basically what happens in our accounts books, we recognize expense over vesting period at using fair value. Okay. Now in the tax books, you recognize it as an expense. You recognize it as an expense on exercise date. On exercise date using intrinsic value. Using intrinsic value. So now tell me, let's suppose reporting date 1, you are under vesting period. Reporting date 1, you are under vesting period. Reporting date 1, let's suppose here. Understand? Please understand. Okay. Now understand. 3 years is the vesting period. Okay, so this is vesting date, and this is your exercise date. This is your exercise date, ED, exercise date. Now here in accounts books we recognized expense. Tell me, will we recognize any expense in tax books? Will we recognize any expense in tax books? No. So this creates a temporary difference. This creates a temporary difference. So hence now, since we will be getting the deduction here, right? We will be getting the deduction here. So when we get the deduction in the future, it will reduce my tax payments in the future. Hence for this we recognize deferred tax asset. Is that clear, everyone? Is that clear, everyone? Come on guys, tell me. Is the logic and the funda clear to all of you? Okay. Now, so now at each reporting date, hence at each reporting date, recognize deferred tax asset for proportionate share of intrinsic value. Okay. If tax laws allow deduction, assuming tax laws allows deduction. Okay, but now there is one point. Now the standard says that. Now hence one more point, very important point. Note, very important point. Note, standard says that if cumulative tax deductions, if future tax deductions exceeds cumulative expense recognized in P and L, then for the difference, deferred tax impact is recognized in equity. Why? So understand, to the extent you have recorded the expense in P&L, to the extent you have recorded the expense in P&L, the deferred tax impact will also go to P&L. Any future deductions over and above the expense recognized in P&L will go to equity. Why? Because this is an equity settled instrument. And IAS 12 on income tax states, if the base transaction is P&L, is recorded in P&L, deferred tax impact will go to P&L. If the base transaction is recorded in other comprehensive income, deferred tax impact will go to other comprehensive income. We saw one classic example of this one in revaluation reserve, revaluation gain or loss. Yesterday we saw that, right? Now third one is, if the base transaction is recorded in equity, then the deferred tax impact goes to equity, right? Hence here it says this statement, which is a very important statement. Now let us take up an example of this one to understand. Okay, chalo. Now, can you see the question, guys? Are you able to see the question, everyone? Are you able to read the question? Is it properly visible? Now, on 1st January 2008, Robinson granted 10,000 share options to an employee. Okay, vesting period is 2 years later on 31st December 2009. The fair value of each option is measured at the grant date was $4. Okay, fair value is $4. Now, tax legislation in the country in which the entity operates allows a tax deduction of the intrinsic value of the options when they are exercised. Okay, now the intrinsic value of the share options was $2.2 on 31st December 2008 and 4.4 on 31st December 2009. Okay, at which point the options are exercised, tax rate is 30%. Now tell me, come on guys. First of all, let us talk from an P&L perspective. Now, tell me, 10,000 options, grant date is, fair value in the grant date is 4. So you will recognize expense of 10,000 into 4, 40,000 over 2 years, that is 20,000 expense here, 20,000 expense here. Here the share-based payment reserve will be 20,000 and reserve will become 40,000 here. Tell me, is it clear? P&L is sorted. Is P&L part sorted, everyone? Now, coming to tax part. Tell me what is the deduction, proportionate deduction for 31st December 2008. What is the proportionate deduction for 31st December 2008? 2.2. So I can say 10,000 into 2.2 divided by 2 years. So it is 11,000. So now tell me, what is the future deduction? 11,000. What is the expense recognized? 20,000. So now where will the deferred tax impact go? P&L, right? Because to the extent expense is recognized in P&L, the deferred tax impact will go to P&L. So deferred tax asset will be created at the 30%, 0.3, 33%, 3,300, right? So the deferred tax asset will be created at 3,300 and the impact will go to P&L. Okay, now on 31st December 2009, the intrinsic value is 4.4. So now tell me, what is the future deduction? It is 10,000 into 4.4, right? Now multiplied by 2 by 2. Total future deductions, total, it is 44,000. Now see, the total expense recognized in P&L is 40,000. Future deduction is 44,000. So first of all, tell me what is the deferred tax on this one? 0.3 multiplied by 0.3. Okay, now, so understand what is the deferred tax asset that we create in the current year? 13,200 minus 3,300 is the movement, is what we will create. We will create a deferred tax of 9,900. Okay, why? Because 3,300 is already there. We have to make it till 13,200. So the extra that we have to recognize is 9,900. Now tell me, what is the amount that will go to equity? How much? Total future deductions is 44,000. Total expense recognized in P&L is 40,000. So the deferred tax impact of the difference, 4,000, will go to equity. So I can say is equals to 4,000 multiplied by 0.3, 30% will go to equity. So what will go to P&L? The balancing figure, this minus this. Simple. I always told you how to calculate what is the amount that goes to P&L. Calculate the movement closing minus opening minus the amount that goes to OCI minus the amount that goes to equity. The amount that goes to equity is 1,200 here. So it is 8,700 here. I believe it is very much clear to all of you. Come on guys, tell me, is it clear? Is it clear, everyone? Is it clear, everyone? Now, tax implication of lease. Tax implication of lease. Tax implication of lease. Now understand guys, on 1st January 2005, Alistair entered into a lease agreement to obtain the use of the asset. The asset will generate taxable income throughout the period. Okay, the lease liability on the lease commencement, it is 260 and ROU is 290. Why? There is a difference of 30,000 because of initial direct costs. So I can say my ROU is 290,000 My ROU is to 90,000. My lease liability is to 60,000. Right now, net carrying amount is 30,000. Net carrying amount is 30,000. Tell me, in the tax books, will we recognize ROU and lease liability? In the tax books, will we recognize ROU and lease liability? No. In the tax books, we simply record the lease payment that we pay as an expense. Okay, see, whatever is the actual lease payment that we pay, we record that as an expense. So there is no asset or a liability that is recognized in the income tax books. So tax base becomes zero. So now, since the carrying amount is more than the tax base, it's a taxable temporary difference, 30,000 minus 0. Okay, now, and hence you have to create deferred tax liability using 20%, that is 6,000 is a deferred tax liability that will be created on the lease commencement date. Okay, now how will it work in the future? So let us compute the ROU. So what is a life lease term? Lease term is 5 years. Lease term is 5 years. So what is the depreciation? Can you please tell me depreciation? This divided by 5 is 58,000. Okay, so I can say this minus 58,000 over 5 years, it becomes 0. Now lease liability is this much, multiplied by discount rate is 5% into 1.05 minus lease payment is 60,000. There might be some rounding of errors which I will ignore. Rounding of errors I'm adjusting so that my answer is not impacted. Rounding of error I have ignored. Okay, there was a rounding of error of 295 that I have ignored. Okay, so the net carrying amount comes to this much. So the temporary tax base is always 0. So taxable temporary difference comes to this much. So now the deferred tax liability comes to this much. So now what will happen? The journal entry. So on this date, you will record DTL, understand, P&L debit P&L, credit deferred tax liability is what you do on the lease commencement date. 6,000. Now subsequently you are just required to reverse the deferred tax liability, debit DTL, credit P&L. By what amount? This minus this. Okay, or you can say simple this minus this, 2200. Okay, now here and here. So this is what is the accounting treatment of deferred tax liability on a lease transaction. Deferred tax liability or deferred tax treatment on a lease transaction. I believe it is very much clear to all of you. Is that clear, everyone? Come on, guys, please tell me. Is it clear, everyone? Is it clear, everyone? Come on, guys. This difference is arising on account of lease payments. Okay, lease payments. Because what happens in P&L, in accounts P&L, you recognize, understand, why is this temporary difference arising? Point is, why is this temporary difference arising? Because in accounts books, you record finance costs and depreciation, right? In accounts books, you record finance cost and depreciation, but in tax books, you record lease payments, right? So there is a timing difference of the amount to be recognized in P&L or tax P&L. Okay, that's why you can do an analysis of it, not an issue. Okay, but ideally this is what you have to do in the exam. Is that clear, everyone? Now coming to the notes, we have discussed leases, in the Excel file. Okay, Now coming to business combination on goodwill. So now, do we recognize deferred tax on goodwill? No. Goodwill ideally is not tax deductible, is not tax deductible. Hence we do not recognize any deferred tax on goodwill. However, if goodwill is tax deductible, then we do recognize deferred tax asset or a deferred tax liability for the same. But we do not have any question from that perspective, so ignore it off. Okay, now fair value of net assets. Guys, understand, if there is a fair value gain, you recognize deferred tax liability on the same. If there is a fair value loss, okay, on date of acquisition, okay, if there's a fair value gain on date of acquisition, you recognize deferred tax liability. If there's a fair value loss on date of acquisition, you recognize deferred tax asset on the same. Okay, now unrealized profit, okay, recognize on unrealized profit, we recognize deferred tax asset. Recognize deferred tax asset on the same. Is that clear, everyone? I believe we have discussed entirely everything from the point of view of deferred tax as well. Is it clear, everyone? Come on, guys, please tell me. Is it clear, everyone? Income tax is clear? Income tax is clear? Chalo. Now coming on to IFRS 8 group accounting, IFRS 19 operating segments. ठीक है. In IFRS 8, more importantly, rather than me teaching anything, I just want you to understand this format of P and L. Okay, this format of P and L is quite very important. So now the P and L is divided into 5 segments: operating segment, investing segment, financing segment, income taxes, discontinued operations. Just keep the format thing in your mind. That's all I want, nothing else from an IFRS 18 perspective. Okay, now moving on to group accounting. Now, before I start this discussion of group accounting, I would like to highlight, guys, on just 1 or 2 weeks back, I have taken a detailed session of group accounting where I have discussed around 31 good number of questions, and the recording is available on my YouTube channel in the live section of my YouTube channel. I'll show it to you guys. I'll just show it to you guys. Just give me a minute. I want you to look at it. Okay, just give me a minute. Though I am discussing group accounting now, don't worry. I am discussing group accounting now, don't worry. But I want you to see something. See, guys, this is our YouTube channel. This is our YouTube channel. Now what happens, whatever sessions I conduct live will feature on the live part. Okay, so if you click on the live and just see here, this video, SBR practice group accounting, and just see the duration of the video, 4 hours 38 minutes. So you can yourself understand how many number of concept based questions I would have discussed. And when I have taken just 3 weeks ago, I have taken is the most latest one I have taken up, and it is very much applicable. Okay, and I request all of you to watch this session right after I complete today's session, plus I also request you guys to watch this FR session. Why this FR? Group accounting revision. Why? Because I have used the same approach like you have to answer in the pre-populated screen. I'll show it to you. See, I'll show it to you. Don't trust me. No, I'll show it to you. I'll show it to see how I'm adjusting things in the spreadsheet. Just see a minute. See here, exactly how you are required to do things in the pre-populated screen. Exactly how you are required to do in the pre-populated screen. Okay, so I have already discussed everything, guys. So I will strongly recommend all of you to watch these two lectures. Watch these two lectures and at length. At length. Will you do that? Come on, guys, tell me. Will you do that? Will you do that? Okay. See, guys, I want basically each of us to respect the time, right? So because if I've already discussed something, and that is very much, see, when did I post this video? Just see the date. 2 weeks ago I have posted this video, right? So it is very much relevant for both FR and SBR students, and it is discussed from, see, I have written in the thumbnail also the spreadsheet approach, right? So it will be very much helpful for you guys, in my opinion, and I will request all of you to watch that. Okay, so I'm writing that also here. So you have to watch 2 videos for group accounting. Watch 2 videos for group accounting. Video number A is FR group accounting practice, of FR group accounting concept, sorry, practice of concepts. Okay, link will be given in description box. Link will be given in description box. Second will be SBR group practice. Okay, and so trust me, guys, in this SBR group practice, I have got conceptual questions from the past papers, practice papers, few questions I have drafted on my own for the questions that can be tested in the exam, and trust me, it will be an amazing discussion for you guys. Okay, so this session you must watch. Okay, now SBR group practice link again will be given in the description box. Okay, now I will be discussing this. Now, you know what? Step acquisition. I have taken up a question on step acquisition in that class. Disposal of subsidiary. I have taken up a question of disposal of subsidiary in that class. Purchase of shares without control, with control retained. Sale of shares with control retained. I have taken a question on all these in that class. A question is taken up. Okay. Foreign subsidiary. I have taken a question in that class. Foreign associate, I have taken a question in that class. Okay, now impairment of goodwill, I have taken up a question in that class. Okay, group cash flows, I have taken up a question in that class. So all those are already discussed there. But now here I want to take this opportunity to discuss first of all the theoretical concepts, so that you revise the concepts with me fatafat. And then what I will do is I have taken up 2 examples. Not 2, rather I'll say 3 examples. One is foreign subsidiary, another is foreign associate, and another is disposal. These 3 examples, which will give you the fair understanding of everything. Okay, chalo, can we start discussing it? Come on, guys, tell me, can we start discussing it? Come on, guys, tell me, guys, come on. Are you low on energy? Are you feeling low on energy? I need some energy, guys. You guys can give me energy. Only you guys can give me energy. Come on, tell me. If you need break, then you can tell me. I can give you break. I don't have any challenge in that. Okay. But one thing I want to assure is group accounting is a very important chapter, and whatever I'm discussing is again very important. Group changes in group structure. So we'll refer to these notes for this discussion. Energy is high. That's what I want. Guys, I request all of you, once this session gets over, all of you will be commenting on this session. Okay, once this session gets over, all of you please do comment in the session, give your honest feedback, a genuine feedback, and after the exams come back to these videos and tell me what happened, what helped, what could have been improved. You please come back and give your suggestions, also give your feedback. If you passed, give your feedback as well. Okay, so now students who are watching in the recorded mode, I request all of you, okay, once you watch and if these sessions help you in your preparation journey, please do give a comment, okay. Chalo, let us start the discussion. Step acquisition. What is the meaning of step acquisition, guys? Come on, tell me. What is the meaning of step acquisition? We acquire control in stages. So earlier we had 30%. Now we acquired 40%. We became 70%. Now, guys, understand the whole rule of step acquisition is we remeasure the previously acquired interest. At fair value on date of acquisition. This is date of acquisition. We remeasure this interest on this date. Any gain or loss goes to P&L or other comprehensive income, and this, whenever we are computing the goodwill, we use the fair value of the previously acquired interest to calculate the value of goodwill. Okay, so goodwill is computed as cost of additional investment, that is 40% that we purchased now, 30% that we purchased previously. We have to take the fair value of that, value of NCI minus fair value of net assets, to arrive at goodwill, or gain on bargain purchase. Is that clear, everyone? Come on, guys, tell me. Now, when you lose the control or dispose of the subsidiary, tell me what happens. In the individual financial statements, you de-recognize investments, recognize sale proceeds, difference to P&L. In the consolidated financial statements or the group financial statements, we de-recognize net assets, we de-recognize goodwill, we de-recognize net assets, we de-recognize goodwill, we de-recognize NCI, we recognize sale proceeds, and if any investments is retained with us, we recognize the investments retained at its fair value, and the difference goes to P&L. Please see here. De-recognize net assets, goodwill, NCI, recognize sale proceeds or investments retained at its fair value. The difference goes to P&L. Is that clear, everyone? The loss of control, is it clear, everyone? Is loss of control clear to everyone? Come on, guys, tell me. Is the loss of control clear to everyone? Okay, now purchase of shares without change of control, meaning thereby earlier I had 70%. Now I acquired 10%, 80%. So in 70% also I had control. In 80% I have control. There is no change in the control. Now tell me, for the 10% that you have acquired, will you recognize net assets? No. Net assets anyways we have recognized 100%. Will you recognize goodwill? No. Goodwill anyways we have recognized for the entire business. Right? So what you have to do? See, when you purchase 10%, your NCI reduces. When you purchase this 10%, your NCI reduces. So what you have to do is, you have to reduce NCI proportionately. Purchase consideration is credited. You have paid the amount, so bank is reduced to bank. The difference goes to other equity. Guys, please understand, whenever there is a purchase of shares or sale of shares, when the control doesn't change, when there is no change of control, the gain or loss goes to other equity. It doesn't go to P&L. But understand, if NCI decreases, meaning thereby you are purchasing shares, You are purchasing shares. In that case, reduce NCI proportionately. How? So NCI was earlier for 30%. Now I want to reduce NCI by 10%. So this is what is called as proportionate decrease of NCI. But if your NCI increases, when will your NCI increase? When will your NCI increase? So please understand the logic also for the same. So when you have 70% plus you acquire 10%, you become 80%. So here the NCI was 30, here it becomes 20. So it is decrease of NCI. Okay, now understand. Similarly, here you had 70, you disposed of 15 and you became 55. Okay, you became 55. So NCI here was 30 and NCI becomes 45. So your NCI increases. So how to increase NCI? So in NCI increase is net assets plus goodwill multiplied by 15%. You have to increase NCI by this amount. See, I have written here also. Net assets plus goodwill multiplied by NCI percentage. Is that clear, everyone? The difference, it will go to other equity. I have taken up a question on this one also, and this one also. All the 4 examples concepts are taken up in that session. All the examples and the questions are already taken up in that session, so no point repeating it again and again. Okay, tell me, is that clear, everyone? Come on guys, please tell me. Come on guys, tell me. Okay, now the next topic is foreign subsidiary, foreign associate. Now in case of foreign subsidiary, can anyone tell me what is the accounting treatment? Though I have discussed again in that class, but let me discuss it again with you guys. Let me discuss it off, okay? Because foreign subsidiary is an important topic, I believe, for this attempt. At least it becomes an important topic in my opinion, because they have been testing foreign subsidiary time and again. They have been testing either foreign subsidiary or okay, but they have not tested foreign associate. In my opinion, they have not tested foreign associate. So they can test foreign associate as well, right? So I will discuss foreign subsidiary and foreign associate both with you guys, okay? So now let us discuss foreign subsidiary. What is the treatment? Foreign subsidiary. Now please understand. Point number 1. All consolidation rules apply as it is to foreign subsidiary as well, except for except for point number 1. Exchange gain or loss on net assets and exchange gain or loss on goodwill. Now tell me guys, Do you remember? Preparing statement of net assets? Do you remember preparing statement of net assets in the group accounting? Do you remember preparing statement of net assets in the group accounting chapter? Statement. Come on, guys. Come on. Everyone. Show some energy, guys. Come on. Guys, we are discussing so important chapter and you guys are low on energy. No. That it doesn't do justice with SBR. That doesn't do justice with SBR. Come on, guys. Okay. Now. Exchange gain or loss on net assets. So now we prepare statement of net assets. Statement of net assets. Okay. Now the statement of net assets has three things. If you remember, these are three things. It has three things. It has opening, net assets on date of acquisition. Okay, add. It has post acquisition profits or losses. Okay, is equals to net asset at reporting date. Tell me yes or no. Right? Tell me, guys, yes or no. Now, so standard says that first of all, prepare statement of net assets in foreign currency. Prepare statement of net assets in foreign currency. First of all, prepare it in foreign currency. Okay. Then convert to functional currency. Then convert to functional currency using exchange rate or applicable exchange rate. Using applicable exchange rate. Now tell me what is called as applicable exchange rate. So net assets on date of acquisition will be converted using a exchange rate on date of acquisition. Post acquisition profits or losses will be converted to functional currency using average exchange rate. Net assets at reporting date will be converted to functional currency using closing exchange rate. Right? Now, when you convert, because you are converting them at different exchange rates, there will arise an exchange difference. This difference is recognized in other comprehensive income. This difference is recognized in other comprehensive income and accumulated in FCTR. FCTR is foreign currency translation reserve for the parent's share. And NCI for NCI's share. Just now I want to take up this opportunity to explain this via some diagram. So let me come to the Excel file, because this topic becomes quite an important topic. So I would like to help you guys in this one. Now understand. Year 1. Okay, now exchange loss 100. Okay, now understand, P holds 80% of S. Okay, now what will happen? So first of all, you will record in OCI 100. OCI you will record 100. Okay, now in FCTR you will record 80 and in NCI you will record 20. Okay. चलो exchange gain I will write exchange gain. ठीक है, चलो. Now year 2, again you got an exchange gain, but this time exchange gain you have got of just a minute. You have got an exchange gain of this time 150. So this 150 will be recognized first of all in other comprehensive income. So if you can see, in other comprehensive income we are recognizing the exchange gain or loss for that year. for that year. Okay, now what we do is we need to accumulate. So what will go to FCTR? Tell me. 150 का 80%, 150 का 80% is 120, right? So 80 of opening plus 120 here. Okay, now NCI 20 opening plus current year is 30. So this is what will happen. Now year 3, let's suppose in year 3 we get a exchange loss. We get an exchange loss of let's suppose what amount? Tell me. 70. Okay, so in OCI you will record 70. In OCI you will record a loss of 70. Okay, now then what will happen? Okay, let me do one thing. 300. Then what will happen? In OCI you will record 300. In FCTR, just a minute. In FCTR, it will be 200 opening. Now, minus 240 is equals to negative 40. We will write. Sir, can FCTR be negative? Yes, it can be negative. NCI 50 opening minus 90. 80 to 40 and 330 20%, 60. Okay, is equal to minus 10. Sir, can NCI be negative? Yes, it can be negative. It can be negative. So this is the treatment which happens. Is that clear, everyone? Come on, guys, tell me. Is that clear, everyone? Now, if it was mentioned exchange gain or loss goes to P&L and not OCI. Now understand, if there is an exchange gain or loss on foreign currency transactions, that goes to P&L. If there's an exchange gain or loss on translation of foreign operations, whether it be foreign subsidiary, foreign associate, that goes to other comprehensive income and accumulated in foreign currency translation reserve for the parent share and in NCI for the NCI share. Is that clear, everyone? Come on, guys. That's a mistake which almost all the students make. They have this wrong misconception. They have this wrong mistake, this wrong idea that exchange gain loss P&L. No, it doesn't go to P&L, guys. And ACCA has tested it time and again. They have tested it by the question name as Carby's company. If I have to say the name, Carby's company is one of the classic example of this question. Carby's company. Please go and solve this question. You will find this adjustment there. Okay. Now, exchange loss on goodwill. So now the standard says that calculate goodwill in functional foreign currency. First of all, calculate goodwill in foreign currency. First of all, calculate goodwill in foreign currency. Then convert to functional currency. And how will you convert to functional currency? So goodwill on date of acquisition less goodwill impairment is equals to goodwill on reporting date. Okay, now goodwill on date of acquisition is converted to functional currency using date of acquisition exchange rate. Goodwill impairment will be converted to a functional currency using average rate or closing rate. Goodwill on reporting date or the closing date will be converted to functional currency using the closing rate. Okay, now if any exchange gain or loss that arises, there will be an exchange gain or loss. Okay, now this exchange gain or loss is recognized in OCI. Okay, and now please understand, Please understand, the treatment will differ now. If NCI is at the treatment, if NCI is at fair value method, then recognize exchange gain loss in OCI and accumulate in FCTR for the parent share and NCI for the NCI share. Why? Because if NCI is at fair value method, the goodwill is full goodwill, meaning thereby goodwill is for parent and NCI both. So if there is an exchange gain or loss arising on goodwill, it will be allocated to both. But if NCI is at proportionate share method, then recognize the exchange gain or loss in OCI and accumulate in FCTR only and not NCI. Strike through. I believe you understood the logic. Come on guys, tell me please. I believe you have understood the logic. Clear everyone? Is it clear everyone? Chalo. Let us come to a question. Foreign subsidiary. Just these two parts I want to show. Rather, rest all things you can do it on yourself. Okay. Allocation of net assets, goodwill. These two parts I want to discuss that with you. Okay. Chalo. Is the question clearly visible to all of you? Is the question clearly visible to all of you? Now it should be properly visible. Okay, chalo. P Limited bought 80% of the shares of S for DN 180 million. Okay, it's a purchase consideration. Okay, retained earnings on the date of purchase was DN 65 million. Okay, so now we can start putting the values also. We can start putting the values for goodwill computation. We need the value of investments 180, value of net assets should be share capital plus retained earnings. So retained earnings is given as 65. Okay, so we'll add share capital also whenever we get the data. Come on, let's see here. The value of the non-controlling interest, it's NCI is at fair value method and the fair value is DN 14 million. Okay, so let's post the fair value. So NCI's fair value is 14 million. Okay, retained earnings here is 65. That also we can post. Now, what else? What is the date of acquisition, guys? 31st December 2080. Date of acquisition 31st December X0. Reporting date is 31st December X1. Reporting date is 31st December 20X1. Okay, chalo. Now, further, P&L is given. Okay, SOFP is given. Share capital is for S is 5 DN. So let me write here, share capital is 5 million DN plus 5. So this is the net assets if there are no fair value adjustments, I assume. Okay, now So what is the goodwill on date of acquisition? It is this plus this minus this. Okay, this is what I assume so far, assuming there are no fair value adjustments as per the question. No intragroup trading. Goodwill on the acquisition of tattoo is not impaired. Goodwill is not impaired. Or shall I change the question slightly? Shall I change the question slightly? Shall I say goodwill arising on acquisition of tattoo is impaired by 10%? Can I do that? Can I do that? Can I make this change? Can I make this change? Okay, impairment. Less impairment. %10%. So this multiplied by 0.1. Okay. So what is the goodwill on reporting date? 111.6 is the goodwill on reporting, but this figure is in foreign currency. We have to compute in the functional currency. Okay, now understand, guys. Further, we need to complete this part of the question also. Equity is 5 and retained earning on the reporting date is 215. Okay, so the post acquisition profit is 150. Just see, the subsidiary profit is 150. Yes, it matches with this data. Very good. So the share capital here is 5, nothing. So just add up everything. Okay, done. Now so we have prepared allocation of net assets. We have prepared the goodwill thing, but everything in the foreign currency is done. Tell me, from a foreign currency point of view, anyone has any query? We have done all the treatment from a foreign currency point of view. We just need to find out the exchange gain or loss now. Tell me, is there any query so far? Come on, guys, tell me. Any query so far? Okay, chalo. Now we have to convert. So date of acquisition using date of acquisition rate, post using average rate, closing using closing rate. So what is the exchange rate? Okay, for each dollar you have to pay 3 DN, 2 DN and 2.6 DN. So you have to convert, divide. You have to divide. So exchange is on the date of acquisition rate is 3. So let us convert by 3. Date of acquisition is by 3. Okay, now average rate is 2.6. Okay, now closing rate is 2. Closing rate is 2. Now let us find out the data. So understand, opening net assets plus profit should ideally be equals to closing. Opening plus post should ideally be equals to closing. So 23.33 plus 57.69 is 81.02, but the closing is 110. So means it's an exchange gain. The net assets increased. It is 81.02. It is 110. The net assets increased. It is an exchange gain of 28.97. And now here, goodwill on the date of acquisition was 41.33, impaired by 4.77. Okay, so what should be the value on reporting date? 41.33 minus 4.77. It should be 36.56, but the value is 55.80. So there is a exchange gain of 4.47. So now what will happen? Tell me, please. Now what will happen? Please tell me. Understand, guys. Understand the treatment. Please understand the treatment. Consol RE, NCI and FCTR. I'm explaining the treatment. Please try to understand, guys. Okay, now post acquisition share of profit, goodwill impairment, exchange gain on net assets, and exchange gain on goodwill. Chalo. Now tell me, please. This post acquisition profit is 57.69. So this 57.69 multiplied by 0.8 will come to consol RE and NCI in the ratio of their holding. Okay. Now goodwill impairment is how much? 4.77. So this minus 4.77 into 0.8 will be taken by consol RE and NCI. Okay. Now exchange gain or loss. What is the exchange gain? 28.97. So 28.97 multiplied by 0.8 here and 0.2 here. Now 14.47 into 0.8 and here 0.2. So this is how. Now understand one more thing. In OCI, what is the value that I will record? I will record exchange gain on net assets. I will record exchange gain on goodwill. So I will record in OCI, I will record 28.97 the entire amount and 14.47 the entire amount. Okay. Now, is that clear, everyone? Come on, guys, tell me, is it clear, everyone? Is the foreign subsidiary accounting clear to everyone? For impairment, you can take closing rate or average rate, whichever rate you are comfortable with. No, not an issue. Okay. The marks will be allocated for both rates. Okay. Tell me, is it clear, everyone? Now, can we discuss foreign associate now? Exchange gain on goodwill should be 19.24. Have I done any calculation mistake? Let me just check it. Might be there is some formula mistake, then I'm sorry for that. There might be some formula mistake, then I'm sorry for that. It should be this plus this minus this. Okay, it was just this minus this. 19.24. Yes, you are right. There was a formula mistake. Thank you, Khushi, for identifying the same. We can adjust it here also. I think we have done. Tell me, is it clear, everyone? I think, okay, just a minute. I think we can take a break now of 15 minutes and then we can resume back and discuss foreign associate disposals. Okay, and then we can discuss few small topics are there for this one, what we say as IFRS 19, IFRS 8 operating segments, and then final note. Tell me, Let's take a break, and then after the break we'll spend around half an hour or 45 minutes, and we will be done. Okay, so let's take a break of 15 minutes and then we'll resume back. Okay. Is everyone back from break? Come on, guys. Come on, come on, come on. Tell me, please, everyone. Okay, guys, I believe there is a time lag of 10 seconds. Okay, I have done a refresh from my side. I request you guys to refresh the window. Okay, if you're watching on a laptop, just refresh the window. Okay, and if you're watching on mobile phone, then close it and start it again. Okay, so the time lag will reduce. Okay, in YouTube generally there's a time lag of 5 seconds, but I think the time lag has increased to 10 seconds now. Okay, can you do that fastly? Can you do that fastly, and then we'll start foreign associate? Guys, are you there? Come on, everyone, tell me please. Are you there, everyone? Okay, chalo. Now we will discuss. Wonderful, wonderful. Now we'll discuss foreign associate. Now in the foreign associate, the treatment is very simple, guys. Where is it? Why? Here we go. The treatment of foreign associate is quite very simple. So now see and tell me, what is the treatment that we give for foreign associate? Equity method, right? Equity method. Now under equity method, what exactly do we do? Tell me. Okay, let me prepare table and explain. Under equity method, so we take the cost of investments. We take the cost of investment. Okay, now the standard says that first of all, compute it in foreign currency. Compute everything in foreign currency. Okay, now cost of investment. Then what? Add share of profit of associate. Then what? Then what? Copy. Share of other comprehensive income of associate. Then what? Less dividend from associate. Now parents share only. Parents share. Okay. Then what? Less unrealized profit. Unrealized profit. Tell me which unrealized profit? A to P or P to A? Tell me which one. Tell me which one. A to P or P to A? P to A. P to A. Okay. Then what? Less impairment loss. Less impairment loss, right? And then it will arrive at carrying amount of investment in associate, right? So now the standard says, first of all, calculate in foreign currency. First of all, calculate everything in foreign currency. Now convert that to functional currency. This one using the exchange rate on date of investment. This one using the average rate. Now this one using the dividend payment date rate. This one using the average rate, and this one using the closing rate. This one using the closing rate. Now there will come up an exchange gain or a loss, and that exchange gain or loss will be recognized in other comprehensive income. Now you will find exchange gain or loss. Exchange gain or loss is recognized in other comprehensive income and accumulated in FCTR and accumulated in FCTR foreign currency translation reserve. Tell me, is that clear, everyone? Is that clear, everyone? Now I have taken up a question on this one. I brought in question. I have brought a question on this one. Okay. Now see the question. Can you see the question, guys? Is the question clearly visible to all of you? Is the question clearly visible to all of you? Here, okay. Now let us discuss this question. Let us discuss this question. Okay. Draw. What is this? Parrot purchases 30% of Anaconda. Oh my God, Anaconda on 1st January 20x1 for 100 million dinar. Dinar is a foreign currency. Okay, so cost of investment is 100 million in foreign currency. Okay. Now, the profit of the Anaconda for the year is 20 million dinar. Okay. So 30% is mine. 30% is mine. We have acquired on 1st January 20x1. Year end is 31st December 20x1. So we have to take the profit for the entire year, but our share of profit. So our share of profit will be how much? Tell me. Our share of profit in foreign currency will be 20 million multiplied by 30% is equals to 6 million. Okay, chalo, now what's next? Other comprehensive income of Anaconda is 5 million. So it will be how much? 5 multiplied by 30% is how much? 1.5. 1.5. Okay. Now anything else? No. So what is the value of investment in associate? It is how much? 107.5. It is 107.5. It is 107.5. Now how to account for it? How to account for it? How to account for it? So let us understand, guys. Just give me a minute. Just give me a minute. So exchange rate on the date of acquisition is 4. Okay, for $1 there are 4 dinars, right? So we have to divide. So dividing it by 4, average rate is 3.6. So divide this by 3.6, divide this by 3.6. Closing rate is 3. So closing rate is 3. So divide this by 3. So this is what. Now understand, cost plus share of profit should be equals to closing. But our cost plus share of profit becomes how much? 25 plus 1.67 plus 0.42 is 27.09. But the value is 35.83. Minus 35.83 comes to an exchange gain of 8.74. 8.74. 8.74 is the exchange gain that comes up. Tell me, is that clear, everyone? 8.74 is the exchange gain that comes up. Tell me, guys, is that clear, everyone? Now, how will the same be accounted for? How will the same be accounted? So here I will write investment account debit to bank by what amount? By what amount? I will record in the functional currency 25. So here I will write investment account debit to P&L. What amount? 1.67. Here I will write investment account debit to OCI by what amount? 0.42. Okay. Now here the closing this much. Now exchange gain increases the value of investment. So what is the journal entry? Investment account debit, that is 8.74 to, it will go to OCI and it will be accumulated in FCTR, foreign currency translation reserve. Foreign currency translation reserve. Now how will the same be presented in investment in associate in SOFP? Will be recorded at 35.83. In console RE we will record 1.67. In other equity we will record 0.42. In FCTR we will record 8.74. Okay. Now in P&L we will record 1.67. And in other comprehensive income we will record share of other comprehensive income of associate as 0.42 and foreign currency gain of 8.74. So this is the presentation in other comprehensive income, P&L and SOFP. Is that clear, everyone? Come on, guys, please tell me. Is the presentation clear to all of you? Is the presentation clear to all of you? Come on, guys, please tell me. Is it clear, everyone? Wonderful, wonderful, wonderful. Okay, so this is also done. Now coming to one important point, though not that a difficult one, but very important point. So guys, understand, see, we record this FCTR, but what happens to this FCTR? So now the standard says whenever you dispose of foreign subsidiary or foreign associate, whenever you dispose of, then in that case you transfer FCTR to P and L. Transfer FCTR to P and L. Now one more point. Now screen is not visible. Hey, it is visible, guys. It should be visible. Okay, now dispose of foreign subsidiary. Okay, sorry. Yeah, now on step acquisition. Now understand one more point. One more point. In case of step acquisition, wherein you move from associate to subsidiary. When you move from associate to subsidiary, okay, so when it was an associate, okay, that is foreign associate, okay, they would have recognized, entity would have recognized FCTR. Okay, so on transfer, on becoming subsidiary, this FCTR balance of associate, okay, should be transferred to P&L. Should be transferred to P and L. Is that clear, everyone? Is that clear, everyone? Now, if you see this question, LUMS Group has sold its entire 100% holding in overseas subsidiary for 50,000. So say sale proceeds, bank account debit. How much? 50,000. The entire proceeds, entire investment is sold. Okay. The net assets on the date of disposal was 20,000. So two net assets, credit, how much? Net assets was 20,000. 20,000. Okay. Now, two, goodwill, credit. What is the value of goodwill? 10,000. Right? Since it was a 100% subsidiary, so there will be no NCI. The difference goes to P and L, credit. How much? 20,000. 20,000. Now, this was not the question. I have taken up this question for this statement. The cumulative balance of foreign groups foreign currency reserve is a gain of 5,000. Now this is only parent share. Guys, understand, this is only parent's share, because NCI share would have gone to NCI. Now in this question, ideally there is no NCI, but if there is an NCI, if the question has NCI, the NCI share would have already went to NCI. So when you derecognize NCI, it automatically get derecognized. Right? The FCTR will have only parent's balance. Okay. So now what will you do on derecognition? What will you do? On derecognition, what will you do? You will transfer FCTR debit to P and L. You will transfer it to P and L, credit. How much? 5,000. 5,000. Is that clear, everyone? Is that clear, everyone? Come on, guys, please tell me. Now, moving on to the here. Now, impairment of goodwill. Guys, one request I have. I have one request. This impairment of goodwill. In that concept class, no, in this concept class, I have already discussed. I'll show it to you. Just hold on a minute. I'll show it to you what I have done there. I'll show it to you what I have done there. Just give me a minute. Just give me a minute. I will show it to you what I have done there in the concept class. Just give me a minute first of all. SBR. Group accounting. Class discussion. See, this is the Excel file of that concept, that 5 hours class. Okay, I will show it to you. I'll show it to you how I have discussed impairment of goodwill there. See, you can see how many questions. See here, I have drafted examples. I have drafted examples to calculate. See, this is from a goodwill wherein the notional goodwill concept is coming up. Okay, I have discussed multiple scenarios. Not only this, there are other questions also where I have discussed this one. I'll show it to you. Don't worry. Hold on a minute. See here. Notional goodwill concept. See here. And this is an exam question. This is the exam question that I have discussed there. This is an exam question that I have discussed there already, right? So I have discussed the conceptual and the exam question both in that session. Tell me, do you want me to rediscuss that part? Do you want me to rediscuss that part? Come on guys, tell me please. Now, let me just quickly give you a brief on impairment of goodwill. Okay, let me give you a brief on. You have seen that lecture? Very good. Very good. Now, impairment of goodwill. Now, if NCI is at fair value method, if NCI is at fair value method, okay, then there is no challenge. There is no challenge. Okay. See, understand. What to test the subsidiary for impairment. To test the subsidiary for impairment, we need the carrying amount of subsidiary versus we need the recoverable amount of subsidiary. Now, in carrying amount, there are two things. There are two things: net assets and goodwill. Net assets and goodwill. Now, understand. If NCI is at fair value method, if NCI is at fair value method, please understand, guys. If your NCI is at fair value method, the net assets are 100% and goodwill is your full goodwill. So both of them are comparable. Both of them are comparable. Now, so there is no challenge at all. So you can compare the carrying amount with that of recoverable amount and calculate impairment loss Okay, and you can allocate this impairment loss first of all to goodwill, and then to remaining net assets, remaining applicable net assets. Okay, now this goodwill, the impairment loss that is allocated to goodwill, will be allocated to parent and NCI in the ratio of their shareholding. Okay, now similarly for this also in the ratio of their holding. But the challenge comes up: what if NCI is at proportionate share method? What if NCI is at proportionate share method? What if NCI is at proportionate share method? Now understand, Your net assets are 100%, but goodwill is partial goodwill. Goodwill is partial goodwill. That makes all the difference. Goodwill is not for the 100% entity. Goodwill here, it is full goodwill. Here it was full goodwill. So there was no challenge, but here it is partial goodwill. And that brings us to the concept of notional goodwill. That brings us to the concept of notional goodwill. That is goodwill for NCI. Goodwill for NCI. Okay. Now understand, when we say goodwill for NCI, do we recognize that in SOFP? No, we don't recognize. Do we recognize that in SOFP? No, we don't recognize. But just for the sake of you can say correct comparison, we add notional goodwill. Just for the sake of correct comparison, we add notional goodwill, we calculate impairment loss, and we allocate the impairment loss. Now what we do is we allocate to parent and NCI. We allocate to parent and NCI, but we do not recognize NCI share of impairment loss. We do not recognize NCI share of impairment loss. Why? Because us goodwill for NCI was also not recognized. If goodwill is not there, how do you think we will impair that? Okay, now this is what is the treatment of impairment of goodwill. I believe it is clear to all of you. Come on guys, tell me, is it clear? Is it clear, everyone? Now moving on to the next topic, that is group cash flows. Chalo. For group cash flows, again in that class I have discussed it. Okay, but still in this today's session I will be discussing the concept of it. I'll discuss the concept of it. Guys, I will be sharing the notes by tomorrow. Okay, tomorrow end of day you will see all the notes in my Telegram group. Okay. Now for that you have to watch that concept practice class. Okay, now understand when you see, I will be discussing from a conceptual perspective. Okay, I will not be going into the depth of it, not practically possible in this session now. Okay, I'll be going into the conceptual perspective. Now understand, when you acquire a subsidiary, you get the assets and the liabilities of subsidiary. But tell me, to acquire the assets and liabilities of subsidiary, do you have to pay any cash? Specifically for the assets and the liabilities, do you have to pay any cash? No. So that is a non-cash item. Please understand. So basically now if you have in the cash flow statements, when you prepare, let's suppose you have to find what is the cash outflow on purchase of property, plant, equipment. Okay, now opening, closing, depreciation, right? Now the PPE of subsidiary that we acquire during the year, it's not a cash flow item. Why? Because here we have not paid cash to acquire. We paid cash to acquire subsidiary, which we will recognize in the investing activity. We have paid cash to acquire subsidiary, which we will be recognizing in the investing activity. But to acquire this PPE, we have not paid any cash. So it's a non-cash flow item. Okay. The best question to practice cash flow are two: Kabilo company and sugar company. Both of those questions you can find in your Kaplan kit. Okay, in your Kaplan kit you can find those questions. Now, impairment loss on goodwill. Is it a cash flow item? No, it is not a cash flow item. So what you have to do? See, impairment loss on goodwill is recorded as an expense in P&L. Right? Now, when we start operating activity of cash flow statements, we start from profit before tax. We start from profit before tax. So goodwill impairment is already adjusted there. So we have to add back the goodwill impairment. We have to add back the goodwill impairment. Why? Because goodwill impairment is not a cash flow item. It is not a cash flow item. Okay. Now, dividend paid. Now, when the subsidiary company pays the dividend, it will pay to parent and to NCI. Dividend paid to parent remains in the group itself because subsidiary and parent is a part of the group. Let's suppose subsidiary paid a dividend. Understand? Subsidiary paid a dividend of 100, to parent 80, and to NCI 20, and to NCI 20. So now what happens? In the group, minus 100. Why? Because subsidiary paid 100. But in the group, plus 80. Why? Because parent received 80. So what is the net outflow? 20. What is the net outflow? 20. So dividend paid to NCI is an outflow of the group. Dividend paid to NCI is an outflow of the group, which is a financing activity. Now, how do you find these figures? Guys, always understand. Think from the T-shape account. Think from the T-shape account perspective, you will find out. Now, NCI has a balance. It will increase due to post-acquisition share of profit. It will increase due to post-acquisition share of profit. It will decrease. Why? Because might be you can say this one. It will decrease. Why? Because the parent has purchased additional shares. Parent purchases additional shares. NCI reduces. Parent sales additional shares. NCI increases. Subsidiary disposed of, NCI decreases. Subsidiary acquired, NCI increases. Right? Now the balancing figure will be dividend paid to NCI. So you have to think from the point of view of T-shape account. Now, understand one more point. How do you find what is the cash paid to acquire subsidiary? Okay, so let's suppose you have paid cash of 1000. You paid cash consideration of 1000. In the subsidiary, there will be some cash and cash balance, cash and cash equivalent, and the subsidiary cash and cash equivalent is 100. So what is your net outflow? 900. 900 is your net outflow, which will be recorded as a cash outflow in the investing activity. Okay, now if you dispose of a subsidiary, then let's suppose you receive a cash consideration of 1000, and in the subsidiary it had a balance of 100. So 900 is a net inflow that you have, which you will record in the investing activity. Okay, now from an associate perspective, the amount that you pay to acquire associate is a cash outflow. Amount that you pay to acquire an associate is an investing activity, cash outflow. Okay, dividend that you receive from the associate is an investing activity, cash inflow. Okay, now share of profit of associate, it is a non-cash flow item. Since it is added to the profit, you have to reduce from the operating activity. Okay, now I will share these notes with you, which will help you in the easy understanding of the chapter. Okay, now what's next? Now there are two topics left. One is IFRS 19. First of all, let's discuss IFRS 19. Guys, do you know what is IFRS 19? Come on, tell me. Do you know what is IFRS 19? Cash flow starting from operating profit. No, cash flow from operating activity starts from profit before tax. Okay, now guys, come on, tell me, do you know what is IFRS 19? So IFRS 19 is, see, understand. This is parent, this is subsidiary A, SA, subsidiary of P Limited. This is S1 Limited. This is S1 Limited, which is subsidiary of P Limited, and this is S2 Limited. This is subsidiary of S1 Limited. Okay, or think you can ignore this part. Now, IFRS 19 says that. Point number one, please understand, IFRS 19 is applicable on this entity. IFRS 19 targets subsidiary. It doesn't target parent. It targets subsidiary. It targets subsidiary. It doesn't target parent. It targets subsidiary. Which subsidiary? Which subsidiary? Subsidiary which does not have any public accountability. Now, what is the meaning of public accountability? Means it is neither listed nor in the process of listing. Nor in the process of listing. Okay, and it is not a bank or insurance company or NBFCs. It is not all these companies. Why? Because understand, bank do accept deposits from the public, right? Insurance company do accepts deposits, or you can say insurance premium from the public, right? So public is involved. They are accountable to the public. They are accountable to the public. NBFCs do accept deposits from the public, right? So they are accountable to public. These companies are accountable to public. So these companies are not. These companies, let's suppose if it's a listed company, listed subsidiary, is the company is IFRS 19 targeting a listed subsidiary? Nah. Is IFRS 19 a subsidiary whose business is in the banking? Nah. Is IFRS 19 targeting a subsidiary who is into insurance or an NBFC business? No. So basically, which subsidiary is it targeting? Which subsidiary is it targeting? It is targeting a subsidiary which does not have any public accountability. Like for example, VJ Private Limited. Tell me, am I listed? No. Do I plan to be listed? No. As of now, no plans to be listed. Now tell me, have I accepted deposits from the public? Have I accepted any deposit from the public? No, I don't accept any deposit from the public. Am I accountable to the public? Tell me, am I accountable to the public? No, I'm not accountable to the public. I am not accountable to the public, right? So might be in that case, IFRS 19 can be applicable on me. Okay. Yes, very good. It is targeting SME companies. Now, further, it also says one more condition. Point number one is subsidiary. Point number two is not listed. Point number three is it is not a bank or a NBFC or insurance. Point number four, its ultimate parent. It has an ultimate parent. Its ultimate parent, that is P Limited, prepares console FS. It prepares console FS. Okay. Now, if all the four conditions are satisfied, then IFRS 19 is applicable on that subsidiary. Now, what does IFRS 19 say? IFRS 19 says that this subsidiary is not required to give detailed disclosures. See, recognition, measurement, everything will happen as it is. Recognition, measurement, accounting, everything will happen as it is. Just that this company is not required to give that detailed disclosures. Why? Because its parent company is preparing console FS. The parent company will give all the detailed disclosures. This company is not required to give detailed disclosures. That's all is the requirement, nothing else. Is it clear, everyone? Come on, tell me, guys. I'll show it to you. IFRS 19 is a disclosure only standard. It does not change how the subsidiary recognizes, measures, or presents transactions. Instead, it provides a reduced set of disclosure requirements for certain subsidiaries. What subsidiaries? Entity is a subsidiary, does not have any public accountability. What is the meaning of public accountability? Its debt or equity instruments are not traded in public market. It does not hold assets in the fiduciary capacity, meaning the bank, insurance, NBFC companies. Its ultimate parent prepares console FS, which is available for public use with full compliance with the full IFRS. With that compliance, full IFRS. Okay. Now, if that is there, for these subsidiary, there is a subsidiary applying IFRS 19 still uses full IFRS recognition, measurement, and presentation rules for transactions and events. Only the disclosure requirements are replaced by disclosure requirements in IFRS 19, that is much shorter disclosures. This is what you have to study from an IFRS 19 perspective. You are not required to say what is the reduction in the disclosure requirements. No, you are not required to study from that perspective. Is that clear, everyone? Come on, guys, tell me. Is that clear, everyone? Come on, guys, please tell me. Okay, chalo. Now the next topic that you have to study is operating segments. Operating segments. Now in operating segments, generally what I have seen in the exam, they test your knowledge. No. Guys, please make this, all the conditions has to be fulfilled. All. I said it, but again I'm repeating it. All. One, two, three, four. All has to be satisfied. Okay. It is a subsidiary. Point number one. Dusra. Second point. Neither listed nor in the process of listing. It is not a bank, insurance, or an NBFC. It is not. Okay. Now, and its ultimate parent prepares console FS. Ultimate or intermediate, whatever is, or intermediate. Why? What is the meaning of intermediate? Let's suppose. Again, this company, S2 Limited, parent, subsidiary of S1. Subsidiary of S1. Okay. Now, this company is also not required to give disclosure if either this company is preparing console FS or this company is preparing console FS. Okay. Then also this company is also not required to prepare console FS. Okay. So if this company is preparing console FS and these two subsidiaries satisfy all the conditions of IFRS 19, then both of these companies are required to give less disclosures. Okay. Now moving on to the operating segments. Now in this chapter of operating segments, guys, how is the class going on so far? Before we start operating segments, come on, guys, tell me, how is the class going so far? Everyone, come on, guys, please tell me. Are you enjoying the session? Was the session helpful? Come on, guys, so far, tell me. Was the session helpful? Yesterday, we revised for around, you can say 8.5 hours. Today, we have revised so far for 5 hours. So 8 plus 5, 13 hours. We have good number of 13 hours. We have done the revision. Tell me, does it, was this session helpful? Was this session helpful? Shall I conduct these type of sessions before every exam? Will it be helpful for my students? Okay, wonderful. So now we will be discussing operating segments. Then I will guide you on some part, and then we'll be wrapping up the session. But before we wrap, I want to tell you, once we wrap up the session, all of you please go and give a genuine feedback in the comment box. Okay, give a genuine feedback in the comment box. Okay. It will be a huge motivation for me as well to work more hard for you guys. Okay, come on. Now, operating segments. In the exam, from an operating segment, generally, what I have seen is they test your knowledge ideally on the thresholds. whether the segment is reportable or not. Whether the segment is reportable or not. Okay. Now, how to identify whether this segment is reportable or not? There are four thresholds. There are four thresholds to identify whether the segment is reportable or not. Okay. Now, what are the thresholds? See, if the segment revenue is 10% or more of total revenue, okay, if the segment result means profit is 10% or more of total profit or total loss, whichever is higher. Now understand guys, here I will like to give some of my interpretation. Let's suppose there are 5 segments: segment 1, segment 2, segment 3, segment 4, segment 5. Now segment 1 has a profit of 50, segment 2 has a profit of 20, segment 3 has a loss of 30, segment 4 has a loss of 5, segment 5 has a profit of, you can say, profit of 10. So now what you have to do, identify, see this one, I'm talking about this one. So you have to see what is the total profit. 50 plus 20, 70, 70 plus 10, 80. So total profit is 80. Total loss is 30 plus 5, 35. Which one is higher? 80. So now 80 is your benchmark. 80 is your benchmark. So tell me what is the percentage? 50 by 80, 62.5 percentage. It is a reportable segment. 20 by 80, it is 25%. It is a reportable segment. 30 by 80, it is 37.5% is a reportable segment. Now you will not say, sir, loss of 30 can we compare with profit of 80? Yes, you can do that. Yes, you can do that. Okay. Now 5 divided by 80, 6.25%. It is not a reportable segment. 10 divided by 80 is 12.5 is a reportable segment. Okay. Now if either segment revenue is 10% more, or segment result is 10% or more, or segment asset is 10% or more, okay, then if either of the conditions are satisfied, we say that the segment becomes a reportable segment. Now if the segment, okay, now understand, limit number 1 is based on revenue, profit and asset. Limit number 2 says if the chief operating decision maker of the company voluntarily wants to report any segment. Ideally, it was not reportable, but the chief operating decision maker of the company, CODM, wants to voluntarily make a segment as a reportable one. Then they can do that. Let's suppose a company is there. There is a company which has opened up a new AI segment. The AI segment doesn't have much of the revenue or the assets or the expenses now. Okay, it doesn't have much of it. It doesn't have much of the revenue or the income or the assets. So ideally, it is a non-reportable. But CODM believes it is reasonable for me to report to my investors that we are investing on AI as well, artificial intelligence. Okay, so they can make it reportable. They can make it reportable voluntarily. Limit number 3. If the segment was reportable in previous year, it will be reportable in the current year also. Limit number 4. Limit number 4 says that applying limit number 1, 2 and 3. Applying limit number 1, 2 and 3. Okay, now entity needs to evaluate whether external revenue of the reportable segments is 75% or more. Basically, reportable segments should comprise at least 75. The external revenue means revenue to outsiders, not within segments. Okay. Now, external revenue of the reportable segments. Listen to me carefully. External revenue of the reportable segments comprises at least 75% of the total external revenue. If that is happening, well and good. If that is not happening, then we have to additionally make some segment as reportable to make it 75%. Okay. Now, some disclosures. Understand. If the company has multiple segments, then the company has to disclose general information about all the segments. What is the meaning of the segments? Which segment comprises of what? segment reporting we have to do, and we have to give entity wide disclosures. Okay, if there is only one segment, then we have to give only entity wide disclosures. What is the meaning of entity wide disclosures? What information about the top products or services, information about top geographical areas, information about major customers. Okay, this is called as entity wide disclosures. Why is segment reporting to be done? Why is it important? Because it increases transparency. The investor will get to know the overall profit of the company this much, but which segment is more profitable, which segment is less profitable. This will help investor to better take a decision. Okay, better decision making, performance evaluation, which segment is performing better, which segment is performing poorer. Resource allocation, if a segment is not performing better, we will not allocate the resource to that, but if a segment is performing better, we will allocate more resource to that segment. Okay, risk assessment, what is the risk in which segment, we will be able to better analyze. Now, so with this we complete the discussion, but just hold on a minute. Now what's next? The final note to my students. Guys, first of all, you have to watch day 1 all of our topics. It is very much required. I will give the link in the description box. Group accounting pre-populated screen, you have to watch. I will give the link in the description box. Group accounting practice part, which I showed the video, you have to watch that. Very important. And also I have made an analysis of the SBR examiner report. I have made an analysis of the SBR examiner report. What are the mistakes which you could do in the exam? So I recommend all the students to watch that video as well. So now all these 4 video link I will give in the description box. Sir, what about notes? What about notes? So notes we will be sharing in my Telegram group by tomorrow end of day. Is that clear, everyone? Is that clear, everyone? Come on guys, tell me. Is that clear, everyone? Now, as the session ends up, I request all of you to share your genuine feedback and honest feedback in the comment box. Okay, in the comment box. And also you can follow me on LinkedIn, and you can follow me on Instagram also, and you can give a genuine feedback in the LinkedIn as well. Okay, now that's all for today. That's all for today, guys. I hope you guys enjoyed the session. Okay, I will be there with you guys till the exam. I will also be uploading pre-populated screen question number one for the pre-mock March 26 in this same YouTube channel. So if you have not subscribed it, please do subscribe the channel, and also share this video with all your friends. Okay, I will be there till the date you are appearing the exam. Thank you guys. I hope I was able to make an impact in your SBR journey. Okay, thank you guys. This is Vishal Jain signing off from your SBR marathon session. Thank you. Bye bye.